All right. Good morning, everyone, and welcome to today's meeting of the SEC's Small Business Capital Formation Advisory Committee. It's so nice to see you all. I now call this meeting to order. I want to extend a warm welcome to everyone, including those members who are joining us remotely today. It's great to see all of you. We also appreciate members of the public who've tuned in to watch the meeting via webcast on sec.gov. Stacy, do we have a quorum for the meeting?
Yes, we have a quorum, and I'll start by giving the disclaimer so we can just give it once, that the views expressed today by the commissioners, myself, or other SEC staff are our own and do not necessarily reflect the views of the commission, other commissioners, or other commission staff.
Thank you, I appreciate that. So we have a full agenda today anchored around continuing to explore ways to support and facilitate capital formation by emerging fund managers, as well as a pivot this afternoon to focus on smaller public companies and the challenges unique to those companies not listed on a national securities exchange. Emerging fund managers play a critical role in investing in early-stage companies, which is why I think it's so important that the committee is spending the time it needs to hear from more participants in this space and help refine our understanding of how regulatory pathways for capital raising are functioning and whether or not any changes should be considered, including to the private fund exclusions from registration frequently relied upon by emerging fund managers and venture capital funds that invest in small companies. We'd love to address these frictions and encourage different and improved behaviors. At our last meeting, we spoke extensively about how emerging fund managers raise capital, various exempt capital raising pathways under Reg D, and certain regulatory challenges those investors face. In particular, we heard from Dr. Sabrina Howell about her academic paper on trends in VC fund managers' use of Rule 506C, and we discussed the advantages and challenges of public advertising by investors seeking to raise capital. Personally, I found it so interesting that smaller and regional venture capital funds play such an important role in making sure that all Americans have access to startup capital from a variety of investors with unique perspectives, networks, and resources, both small and large. We also identified and discussed certain relevant registration frameworks applicable to private fund advisors and their funds, including exemptions from registration requirements, with a view toward better understanding whether the exemptions, as currently structured, feel adequate and appropriate, and whether they meet the needs of the funders who rely on them. Throughout these conversations, the importance of networking and relationship building shone through, and as a committee, we discussed how impactful personal networks can be to founders as they raise capital, and the importance of ways to expand those networks. Building upon ideas generated during our prior committee meeting, today we'll pick back up on those capital raising issues confronting emerging fund managers and hear from two industry participants to facilitate further discussion. Then, later this afternoon, I'm really excited for us to shift gears and tackle a new topic, exploring the challenges of small public companies that are not listed on a national securities exchange. I think that understanding the decision points and challenges these companies face is critical to fostering access to capital for and investor participation in those smaller public companies. To this end, we will hear from the General Counsel at OTC Markets Group about some of the challenges facing smaller public companies who are not listed on a national securities exchange. I anticipate that this afternoon's conversation will provide insights into small business capital formation challenges that we may wish to consider and further explore in future committee meetings. But before we get to this exciting agenda, we are so pleased to have Acting Chairman Ueda and the other commissioners join us today. We really appreciate you all being with us this morning. Acting Chairman Ueda, would you like to start with your remarks?
Well, thank you, Erica, and good morning to everyone. Great to see all of you in person here. You know, Washington, D.C. in February is kind of a mixed bag. We could be under 5 inches of snow, or we can have decent weather, and so I think today is supposed to be fairly nice. So for those of you who came from warmer areas of the country, thank you for bringing the nice weather with you. Yesterday, I had the privilege of speaking to the Florida Bar, and one of the organizers of the event was Greg Yadley, who was a long-term member of this committee and its predecessors, and he sent along his regards and his appreciation for all the efforts that this committee does to carry on its mission of looking at small business capital formation. Well, welcome to the first meeting for the committee for 2025. I expect this year will be a busy and exciting one for the committee, as I've asked the commission staff to explore various ways to improve capital raising opportunities for entrepreneurs and to empower retail investment in private companies. These topics are at the heart of this committee's expertise, and I hope that you will have the opportunity to share your views and your experience with the staff, the commissioners, and the public. Turning to today's agenda, I'm pleased that the committee continues to discuss ways to support and facilitate capital formation for emerging fund managers. The lack of appropriately tailored disclosure for smaller advisors starting their businesses is concerning because it can lead to disproportionate compliance burdens and create barriers to entry. I look forward to reviewing the input from Ashok Kamal and Sarah Zolkowski on these issues and any recommendations from the committee to address them. And later this afternoon, the committee will discuss the challenges faced by small public companies that are not listed on a national securities exchange. I believe that scaled disclosure requirements is important for smaller companies, as the cost for preparing disclosure can be disproportionate, especially for smaller companies. Small companies that are not listed on an exchange may face even more unique challenges. For example, unlisted companies with a public float of less than 75 million are ineligible to use shelf registration statements. There also may be investor protection concerns associated with small companies whose stock have relatively low liquidity and may be more prone to manipulation. However, do these concerns justify not permitting small companies that may be in greater need for capital than larger listed companies to use shelf registration statements and quickly access the capital markets when timing and other conditions are ideal? I look forward to reviewing a readout of Dan Zinn's thoughts on this and other issues facing small unlisted companies, as well as the committee's discussion on potential solutions to these issues. So thank you very much, and I hope you have a productive meeting today.
Thank you so much, Acting Chairman Ueda. Commissioner Peirce, we would love to hear your thoughts.
Thank you, Erica, and thanks to the committee members for being here or for tuning in online, and thanks for those who will be presenting to the committee today. I recently read Olympian Sydney McLaughlin-Levroni's biography, and it inspired me to rewatch several of her Olympic and other races that she ran. She set the world record in the 400-meter hurdles, and she did it with such ease that the hurdles almost seemed like they were non-entities. She just is so smooth, and it's such fun to watch her. But reading her book made clear that gliding over the hurdles at breakneck speed requires not only a lot of natural talent, which she clearly has, but also hard work, persistence, tough lessons, and pain. So, of course, her story made me think of emerging fund managers and small public companies. Celebrating managers and companies that have managed to succeed in building thriving enterprises is really exhilarating, but we sometimes forget that difficult journey that brought them to success. Hard work is unavoidable, and nearly every founder and fund manager has endured trials along the way, but regulation can either increase or ameliorate those burdens. Today's discussion and any ensuing recommendations can help the Commission identify regulatory hurdles that are impeding emerging fund managers and small public companies. I'm glad that the discussion of how best to support emerging fund managers and facilitate capital formation is continuing from the last meeting. An important piece of the puzzle is understanding how fund managers and angel investors find each other in the marketplace and develop relationships that facilitate a mutually beneficial deployment of capital. As the committee discussed previously, such professional relationships can be harder to form without pre-existing familial or personal relationships. I look forward to hearing any recommendations that these conversations generate. This afternoon, as you've heard, the committee will turn to issues further along in the startup life cycle, how small public companies think about access to capital and the cost of regulatory compliance. Our regulatory framework should ensure that at every stage of growth, companies have access to capital with the end goal of becoming publicly traded so that all investors can participate in future growth. The once aspirational goal of becoming a public company seems to have lost some of its luster, but I think we can change that by identifying and addressing the hurdles to going and staying public. I do have a few questions for your consideration during today's meeting. What are the biggest impediments or market conditions swaying private companies away from entering into the public markets? Once public, what are the most pronounced costs newly public companies bear, and how could the Commission mitigate any costs that are necessary for investor protection and eliminate costs that lack a concomitant investor protection benefit? And finally, what changes should the Commission make to ease the burden on smaller public companies and public companies not listed on a national exchange? Thank you, and enjoy the rest of your meeting.
Thank you so much, Commissioner Peirce. I'm pleased to invite Commissioner Crenshaw for remarks.
Good morning. Thanks, Erica. And thank you to the committee members and today's speakers for making the time to participate in the meeting. As always, we appreciate it. And also thank you to the staff, those of you in the room, those of you online, and those of you who facilitate this meeting. It's been a long couple of weeks, and really appreciate that we can continue to hold these important meetings and get your thoughts on how we can facilitate capital formation, which we couldn't do without the hard work of the staff. So before I get to the agenda, there is one point I want to raise. To the small businesses impacted by changes to grant distribution and federal funding, I want to hear about those changes. Small businesses do not rely solely on debt and equity raised in capital markets. Rather, their funds come from a variety of sources, including grants. As we think about the policies here today, it's critically important we understand and acknowledge the whole landscape of challenges that face small businesses. And we need to ensure that in the changing landscape, our policies are the right ones. To help meaningfully solve capital formation issues, we need a complete view of small business capital formation challenges. That currently includes, among other things, consideration of the impact little or no traditional grants or federal funding has. With that in mind, today we'll discuss the challenges of emerging fund managers and small public companies when they're not listed on an exchange. Regarding emerging funds, I know that you are actively considering a couple of recommendations, perhaps to raise certain thresholds, allowing emerging funds to have access to an additional investor pool with fewer regulatory obligations. I'm interested in your ideas on how to reduce systemic barriers for these emerging funds. What are those systemic barriers? We need to carefully identify the problem that these funds are facing and explain the rationale for any recommendation. To the extent changes can reduce unnecessary frictions and simultaneously promote investor protection, we should absolutely explore them. However, it is also important to carefully consider whether adjusting certain thresholds would result in marginal changes at best, while increasing investor protection concerns, while also not addressing any systemic barriers. Smaller reporting companies that are not listed. The second topic explores the challenges faced by small public companies that are not listed on a national securities exchange, as you've heard. This is certainly an area worth understanding. As you think about these recommendations and about the information here, there are certainly competing interests. The over-the-counter markets, where unlisted companies trade, are less liquid than a national exchange. Additionally, investors in those markets do not benefit from exchange-monitored and enforced listing standards. Is the reason for the reduced liquidity the result of opacity rather than investor access? Do we have any data suggesting that an increase in investor base results in more liquidity? Is there a correlation? Additionally, what are the costs to investors in the markets in terms of increased fraudulent activity? To be clear, this is not a consideration of whether or not investors can calibrate their own risk tolerance, but whether the benefits of any potential changes outweigh the costs. While making OTC markets more accessible may, in theory, increase liquidity, it would also be important to ensure commensurate increases in price transparency and disclosure monitoring. Lastly, the committee discussions are opportunities to zoom out a bit and think holistically about our regulatory frameworks. And perhaps this is an opportunity to step back and think about whether there are improvements to the path from private company to reporting company to public company listed on a national exchange. As this committee well knows, the data clearly show that Reg D, which only requires a very limited form disclosure, is used to raid multiple capitals of Reg A or Reg CF, which have scaled disclosures. This committee could consider whether there is a way to incentivize a pathway for private companies to raise capital through exemptions with scaled disclosures, and then become an exchange-listed company when it's time to go public. Would this result in companies staying private for longer but raising capital through Reg A? Would there be a benefit for such companies once they go public, given the availability of disclosures filed through Reg A? Would that result in more interest and liquidity for a company's securities in the public market? We should think through these things not because there's a particular path that companies should or ought to take, but because there are significant benefits to investing in companies listing on a national exchange. Public exchanges are well-lit venues that enjoy high degrees of liquidity and integrity. And most importantly, the securities that trade on these exchanges are often the most accessible way for American investors to share in the entrepreneurship and prosperity of our economy's innovation. My view is that the sum of our mission, facilitating capital formation, maintaining fair, orderly, and efficient markets, and promoting investor protection, is growing the economic pie through innovation and entrepreneurship, and then making it accessible and reliable for all Americans who are able to invest. Thank you.
Thank you, Commissioner Crenshaw. That was really informative and thought-provoking. We appreciate that. And I want to thank the acting chair and all of the commissioners for your remarks today. It's really valuable to us. I did also want to take another opportunity to welcome our newest committee members. So we'd love to give each of you the floor for a few minutes so that you can share a little bit about your backgrounds. Well, first introduce yourself, share a little bit about your backgrounds and what drew you to join the committee, and maybe a couple of the topics related to small business capital formation that you'd be interested in seeing the committee address. So first, I'd like to invite Jennifer Newton.
Thank you so much for having me. So I'm super excited to be here. I'm Jennifer Newton. I am the founder and the CEO of Start Smart Counsel, and we are a law firm that supports small businesses and startups. Most of the services that we provide are around the business formation, but also regulatory compliance, corporate governance, and also assisting startups with capital raising. And so one of the most important reasons why I joined is because I'm interested in learning how we can demystify the pathway into getting access for capital to startups and also small to medium-sized enterprises. Super excited to be here, so thank you so much for having me.
Thank you, Jennifer. I'd like to introduce Rose Standifer. Rose?
Good morning, everyone. My name is Rose Standifer. I am a partner with Foley Hoag, which is an international law firm. We have a very large emerging companies practice representing both issuers and investors across several emerging technology sectors. My practice for the last 20 years has been split between issuer side and investor side, and working along the spectrum from formation all the way to IPO and continual capital raising after going public. One of the reasons I joined the committee was around that cost-benefit analysis, I started my practice for over 15 years in Silicon Valley, seeing the ease of which it actually is to raise capital when you have network effects. How do you balance in the dilutive fundraising if you don't have those pre-existing relationships but still ensure a sort of honest actors disclosures? I find it just very fascinating who has access to capital, who wants it, and who doesn't. And where's that line? Where's that balance? And seeing it, I worked on one of the first IPOs under the Jobs Act, scaled disclosures. Did that work? Did it not work? So these are the areas that I'm interested in and why I'm here on this committee.
All right, thank you, Rose. Next, we have Wendy Stevens. Welcome, Wendy.
Thank you. I'm so glad to be here, and nice to meet you all in person. I was given 2 to 4 minutes, so I'm going to take every one of them. If you Google me, you may think I'm a composer, teacher, pianist, pocketbook designer, hair salon owner, or actress. Before you get to the real me, I'm a CPA, and that's why I'm here. We were looking for a CPA on this committee. I had heard that through some of my DC channels, and I applied on that basis. I spent the first half of my career working on very similar things that Rose talked about, with evolving companies and all different kinds of capital raise, from the smallest to the IPO, to ultimately companies that became larger reporters. I appreciate what Commissioner Crenshaw said about the order of capital markets, but my particular interest is in scalability and proportionality related to the entities. And I did read Mark's speech yesterday, and I think you touched on some of that scalability and proportionality is really important. So the second part of my career is very much in settings like this, which is either standard setting or recommendations for regulatory type changes, whether with the SEC, the PCAOB, and right now my largest role is with the International Auditing and Assurance Standard Setting Board that sets auditing standards for the globe, and then in each jurisdiction they take those down. I've seen firsthand the trials and tribulations of small reporting companies, and somebody asked the question about what stops them. Basically, it's money and the cost to actually raise money and not having the networks to be able to do that, and maybe not having the right advisors, which also costs money. So there's a lot of different pieces to the circle that caused angst and anxiety and ability to be able to raise the capital. So in my current role, I'm a partner at Forbes Mazars, a newly formed top 10 U.S. and top 10 global network that's really important in the profession and in the accounting world. And probably if you do go on LinkedIn, you can find anything else out. I'm truly passionate about what I do, and I'm truly passionate about this type of volunteerism along with my day job to make a difference. Whether it, in this particular case, I think it's really important that all entities that want access to capital have that access. So thank you.
Thank you so much to our new committee members. We are really thrilled to have you here. Next up, we are pleased to welcome fellow committee member and the director of the SEC's Office of the Advocate for Small Business Capital Formation, Stacey Bowers. Stacey is going to provide an overview of one of my absolute favorite documents in the world, the office's fiscal year 2024 annual report. I was so excited to hear that this was coming out, and I was going to get one today. I actually keep a copy on my desk at work because it's so full of important and valuable information to refer to at any time. It's an in-depth, it includes in-depth data and analysis on the state of capital raising activity along with the office's policy recommendations. So I think you'll all find that the data and information Stacey will be sharing is particularly relevant to both our ongoing discussion of ways to support emerging fund managers, but also to this afternoon's small public company topic. I know I'm lucky enough to have this wonderful printout, but I believe for anyone who's joining us by webcast, you can also find a copy of it online through the sec.gov website. Stacey, thank you.
Thanks, Erica. Well, good morning, everyone. It's great to see so many of you in person and to welcome our newest members, Rose, Jennifer, and Wendy. And hello to everyone who's on Webcast as well. So as you are aware, and as Erica just said, our new annual report is available online, and everyone who's in the room today, you have a copy at your seat. Before the meeting swings into gear today, I just want to take a few minutes to highlight some of the data from this year's 2024 annual report. I'm going to brag a little bit. The team in OASB just does an amazing job putting this report together every year. I have the luxury, I get to read it after they, as they're doing all of the work, but it's just amazing to see the team come together and what they do. So I know we have a full agenda today, so I'm not going to spend a ton of time talking about the annual report because you can peruse it on your own. But I do want to go through and just highlight some of the important data points. And as Erica mentioned, I'm going to try and highlight some of the points that go to the discussions that will be happening today. So I'm going to lead off by talking about some of the data that is just general in nature as it pertains to small businesses and capital formation. I'll give you the page numbers as I go along, so if you want to crack open those annual reports, they're brand new, and take a gander as I talk about it. So on page 4, I don't think this is news to anybody, but 94% of Americans state that it's important to have a fair opportunity to start and grow a business. And since 2011, 80% of net new jobs have been created by small businesses. That's a pretty significant amount of new jobs being created by small businesses every day. On page 5, very similar to what we've reported in the past, in 2023, 93% of small businesses experienced financial challenges. That's down just slightly from 1% in 2022. Some of the main challenges encountered were the rising costs of goods, services, and wages, and operating expenses. And not surprisingly, access to capital continues to be an issue for entrepreneurs and creates a barrier to growth. Page 7. When we take a look at how small businesses secure capital, only about 2% of small businesses receive an equity investment. So that's a pretty small slice of the pie when you think about where capital is coming from. The most common types of equity investments come from the owners themselves, about 70% of the time, friends and family, 60% of the time, angel investors, 30% of the time, crowdfunding, because I know the committee has talked about it in the past, 17% of the time, and venture capital firms, only 8% of the time. So I'm sure all of you in this room, and we hear it ourselves when we're engaging, small businesses have this idea, I'm going to get venture capital money. But in the scheme of things, very little of the equity financing is coming in from venture capitalists. On pages 8 and 10, as our office heard frequently over the past year, small businesses need support in order to grow and build their companies. And they often turn to accelerators, incubators, and other entrepreneurial support organizations for that support. In particular, businesses value network development, access to potential investors, and mentorship from experts as some of the most important benefits of these support organizations. And we're going to hear from one of those support organizations this morning, Recast. And then angel investors play a critical role here as well. They can play a key role in mentoring and funding small business founders. So they play, along with the entrepreneurial, more official support organizations, angels also play a role in mentorship. Page 14, this lines up with what we've reported over the past couple of years in our annual report, but Rule 506B is one of the most commonly used regulatory pathways by companies, with 170 billion raised, while only 12 billion was raised under Rule 506C and 1.5 billion under Regulation A. When we take a look at registered offerings, 28 billion was raised in IPOs versus 1.2 trillion in other registered offerings. Page 15. When examining the exemption pathways that pooled funds use to raise capital, 1.7 trillion was raised pursuant to 506B, with only 125 billion pursuant to Regulation 506C. Keeping in mind that there we're talking about how pooled funds are raising capital. And then on page 16, taking a quick comparative look at how much money was raised from investors by U.S. private companies versus public companies. Private companies raised $623 billion, representing 34% of all capital raised by U.S. companies, while 66% of capital, or $1.2 trillion, was raised by public companies. So that's a little bit of the high-level background. I do want to highlight a few points that pertain to what's happening with venture capital investments. So we're going to go back a little bit further in the annual report to pages 24 and 25. So while deal flow remains steady, they are still below the 2021 peak, with $87 billion invested in both early stage and later stage companies across approximately 4,600 deals. But the time between VC rounds remains high at 2+ years between almost every round of venture capital financing. Pages 26 and 27. Large funds continue to be dominant, with 63% of capital concentrated in funds with $500 million plus in assets, which is up from 55% in 2023. First-time VC managers continue to face challenges, with a 49% decrease of first-time funds in 2023, making up only 26% of all funds, and only 56 first-time funds created in the first half of 24, which suggests there may be another record low on this front by year-end. Additionally, institutional investor appetite for investing in first-time or new VC managers is starting to decrease again, with 42% of institutions reporting they do not invest in first-time managers, up from 28% in 2023, but down from 51% in 2022. Page 28. Overall, emerging fund managers continue to experience a decreased market share. In the first half of 2024, emerging fund managers made up half of the total firms, but raised less than a quarter of total capital. Let's take a look at the IPO market and what's happening with IPOs and small public companies. Page 31. There was a slight increase in IPOs in the first half of 2024, with 101 IPOs raising $19 billion, compared to 83 IPOs raising $11 billion in the first half of 2023. So we're seeing a slight uptick there. And technology is the top industry raising capital through an IPO. On page 32, small companies accounted for 40% of IPOs since 2022, but only about 4% of the actual deal value. There were 37 microcap IPOs in the first half of 2024, raising $300 million, compared to 48 large company IPOs in that same period, raising $17 billion. Also in 2023, there were 54 exchange-listed IPOs, up from 38 in 2022, but still quite low. Page 36. While small public companies make up half of all public companies, 33% are not exchange-listed, as compared to only 2% of large public companies that are not listed on an exchange. Page 37. Public companies that had a market cap of less than $500 million or revenues less than $50 million traded down at much higher levels than larger public companies. Additionally, small cap companies face pricing struggles, with 22% on an exchange non-compliance list, which is down from 34% in 2022, and 42% executing reverse stocks, also down from 51% in 2022. Page 38. Of the 2,600 small public companies in the market, only 13% raised capital through a registered equity offering in the 12-month period ended June 30, 2024. The average proceeds raised in the first half of 24 were $13 million, with total offerings of 232, raising a total of $2.9 billion. And the top industries for small public companies are healthcare and business services. Page 40. Small public companies continue to face investor relation challenges, such as stock volatility, finding new investors, and building strong analyst relationships. And many do not have any analyst coverage, with 44% of small public companies having no coverage and 35% having only one to five analysts covering the company, compared to 73% of large cap companies that have 10 or more analysts covering them. All right, of course, I want to highlight a couple of other things that aren't data points in the annual report. So as you know, every year, the annual report includes recommendations based on the input our office receives from all of our stakeholders that we engage with throughout the year. So just to highlight a few of those, there's a recommendation on crowdfunding and making it a more attractive pathway, a recommendation asking for clarity on the role of finders, a recommendation calling for the exploration of solutions to support emerging fund managers, and a recommendation on continuing to support small public companies. I also want to note that since the launching of the Resources for Small Businesses Hub, or what used to be known as the Capital Raising Hub in 2022, there has been more than 1.5 million views of our resources. We continue to add to our educational resources over the past year. We put up some new building blocks. So in case you haven't seen them, there's some building blocks on financial statements these days. We have added to the glossary terms, and we have also launched our Let's Talk Small Business video series. So if you haven't had a chance to check them out or to tell your friends and family and your clients about them, it's a great series of videos where we're talking to just different people in small business capital formation, and they're sharing their points of view. And last, but of course not least, you'll find the committee highlights and recommendations starting on page 103 of the annual report. And again, much like the commissioners say, I want to thank all of you for being here, giving us your time to be a part of this committee, and sharing your thoughts and recommendations.
Thanks so much, Stacey. We really appreciate that. As I mentioned at the outset of the meeting, we plan to spend the remainder of the morning building upon the robust discussions that we had during the committee's meeting on November 13th, 2024. Continuing to explore ways to support and facilitate capital formation for private funds and emerging fund managers. And one thing that I just want to clarify, because I think that the phrase emerging fund managers isn't, sort of a layman's term. And even many people in venture capital for a long time didn't really know what it means. So technically, when we talk about emerging fund managers, we mean fund managers that are on Fund 1 through 3. So it's not just people trying to raise a fund. It's not even just people who have only raised fund. Technically, you are actually considered emerging until your third fund. So good for us to just have some context there. It's my hope that this discussion today will result in our ability as a committee to propose recommendations to the Commission. To facilitate our discussion and deepen the committee's understanding of certain capital raising frictions, we are going to hear from the director of one of the country's leading angel investor groups. And after, the committee will have the opportunity to learn more about the role of emerging fund manager accelerator programs and how they can help reduce institutional barriers for funders. Specifically, we're going to learn about Recast Accelerate, which is designed to accelerate the success of women-led emerging U.S. venture capital funds. Recast has made a big impact in the emerging manager space with innovative and unique programs designed to make sure that talented fund managers have the resources they need to get their funds off the ground and access to the important networks that are crucial in developing a venture capital franchise firm. So I'd like to start by introducing and welcoming Ashok Kamal. Oh, okay, sorry. Actually, we're switching it up a little bit. I'd love to start by introducing Sarah Zulkowski from Recast, co-founder and managing partner at Recast Capital. Prior to co-founding Recast, Sarah served as a venture partner at Greenspring Associates, now Stepstone Group, a principal with CNF Investments, and held other industry roles before that. Sarah received an MBA from Georgetown University and an MS in Engineering Management and BS in Mechanical Engineering from George Washington University. She's also a member of the Kauffman Fellows Class 23. And apparently she is on her way down. Oh, great, here she is. All right, just in time, Sarah. I think, is she gonna go there? Okay, great. Wonderful. So Sarah, I've made a beautiful introduction for you and told everyone how amazing Recast is. And we are very excited to give you the floor.
Hi, everybody. Sorry, sneaking right in today. Thanks for having me. I have some prepared remarks to share. If there's questions that you have as I'm going through those remarks, please feel free to stop me. Otherwise, plenty of space at the end for those questions too. Chair, Vice Chair, and committee members, thank you so much for the opportunity to speak today and contribute to the discussion about emerging managers. My name is Sarah Zlokowski. I'm one of the co-founders and managing partners of Recast Capital. We're a platform that's both investing in and supporting emerging managers in venture. Today, I'm excited to discuss how programs like ours address institutional barriers that emerging managers face today. I understand that Karen Kerr, PhD board member and charter class Kauffman Fellows and managing director with Exposition, was here at your last session to discuss some of these challenges. So we're excited to build upon that conversation with some of our learnings as well. First, a little bit about us, just for some background and our experience in the space. Recast is a 100% women-owned platform that's both investing in and supporting emerging managers. My co-founder and I came together with a common vision for where we felt returns were actually being generated in venture today, and that's very squarely at the intersection of three key areas. Emerging managers, or those raising funds 1, 2, or 3, where your incentives are most aligned with your limited partners. At number 2, smaller fund sizes, or said differently, more appropriately sized funds for their strategies in early stage investing. On some level, it's simple math. It's easier to 5x a $100 million fund than it is a $1 billion fund. And then finally, number 3, funds led by partners with different lived experience, perspectives, and networks that were driving unique and differentiated deal access and opportunities to win in the exceptionally competitive environment that is the venture capital industry today. We recognize that many savvy limited partners understood our investment thesis and believed our investment thesis, however, had a difficult time accessing emerging managers directly, largely because of check size constraints or team bandwidth. We also recognize that there was an opportunity for groups like ours to step in and really build institutional level programs to support more of the community than just those that we could invest in. So in response, my co-founder and I launched Recast in 2020 to include an emerging manager fund of funds program as kind of an institutional intermediary to help address some of the access challenges I mentioned, but also a series of GP-centered programs that would allow us to support more of the emerging manager community. So we're committed to democratizing access to information, and our GP programs are a way for us to essentially productize the support that we've offered managers through the years on kind of a one-off basis. We do that through 2 programs today. The first is our enablement program, which is a virtual tuition-free educational program for emerging managers. And the second is our Recast Accelerate program, a philanthropic initiative that was built on the learnings from enablement over the years. It really supports its program participants by providing access to not only the key educational content I alluded to from enablement, but also executive coaching, peer learning opportunities, robust firm building resources and shared services, and then $100K in operational support for each fund, all with the goal of accelerating their growth in the space. To date, we've supported 134 managers through our GP programs. 80% of those managers have included at least one GP who identifies as a woman or non-binary, and 62% have included at least one GP of color. So why are we here today? Challenges faced by emerging managers. So hopefully that gives you some context to why we feel like we're appropriate to sit at the table and share some thoughts today. From our perspective, the primary challenges can be grouped into 3 specific categories. Access to capital and fundraising, firm building and operational issues, and then candidly institutional biases. Capital access and fundraising remain the primary challenges. I think you all recently released a report, your 2024 findings, that I think would agree with many of the comments I'll make here, so excuse me if you've heard some of these before. But according to PitchBook, first-time fundraising hit decade lows in 2024 in both fund count and total capital, down dramatically from 2024. Established firms captured about 80% of the total capital raised in 2024, the highest concentration in a decade, leaving emerging managers with significantly smaller share of that available capital. And for the first time in a decade, there were more established funds than emerging funds in the market. So instead, many emerging managers have opted to delay their fundraising in hopes of an improved market conditions in the future. I think one important reason for these statistics is the tendency for institutional investors to avoid first-time fund managers, believing them to be too risky, preferring to focus their capital into more established managers. Emerging managers are then forced to focus their fundraising efforts on high net worth individuals and family offices. And these LP archetypes are difficult to penetrate because they typically commit smaller check sizes, require more total commitments or more yeses. You're having more conversations in order to close your fund. And this proves especially challenging without an existing network of LPs, of that archetype, family offices and high net worth contacts, creating significant barriers for new fund managers that aren't spinning out of established shops that have those relationships, or are just not, their own personal networks are not as robust to be able to tap friends and family in order to invest in their funds. To be honest, most of us are not in that camp. Because there's so few GPs at established firms from underrepresented backgrounds, I think this particular barrier, the lack of the LP network, is felt even more acutely with diverse-led emerging venture funds. Even when emerging managers do attract interest from larger institutional investors, structural issues persist there as well. Large institutional LPs frequently have minimum fund size thresholds and or minimum check size constraints. So emerging managers of more modest fund sizes, which is certainly typical, are not a possible target for any of those LPs. Firm building and operational challenges also weigh heavily on emerging managers. They're building their firms, they're startups in and of themselves. They have to wear multiple hats. So not only are they identifying companies to invest in, raising capital, but they're also forced to manage legal, compliance, accounting, fund administration, tax, audit. The list goes on. And without a network of GPs that have kind of been there, done that, or advisors that understand the venture landscape and who can help address these firm building challenges, it can be difficult to build a firm that leverages the right outsourced service providers to not only allow the GPs to focus on what they should be focusing on, which is identifying great companies to invest in, support winning allocation in those companies, and supporting them in an exceptional manner, but also give prospective LPs the peace of mind that the fund has the appropriate scaffolding in place to actually operate their fund like a business, because that's certainly a part of the assessment as well for institutional investors. So if you don't have these things, you're clearly at a disadvantage. I think, in speaking to operational barriers, one cannot skim over what I believe to be a very significant impediment, which is the 1% GP commit expectation in our industry today. Potential limited partners and venture funds have a clear interest in ensuring that the fund's GP is focused on stewarding their capital, generating returns, of course, and the standard solution to ensuring that focus has been to invest along GPs who are putting their own money into the fund, right, representing that skin in the game, if you will, theoretically aligning incentives when a GP is calculating risks that they're willing to take and whatnot, making decisions. But the 1% standard, which was established over 3 decades ago, has unfortunately evolved to become the market expectation and requiring emerging managers to commit large amounts of capital to their fund despite their personal financial constraints, despite the fact their professional reputations are on the line and building their funds already, unnecessarily penalizes those that are not from affluent backgrounds. And to be fair, the majority of new firms that are led by those outside of the venture bubble, not spinning out of established venture firms, fall into that category. So this in turn prohibits many exceptional managers from starting their firms. Finally, the third category of challenge I mentioned was kind of institutional biases, both implicit and explicit, that continue to challenge emerging and diverse-led venture funds today. In venture and private, and these are stats that I know you all know, but for the purposes of driving the point home, in venture and private equity, it's estimated that only 5% of firms are women-owned and only 4% minority-owned. Because of this, emerging GPs from underrepresented groups often are confronted by skepticism from some capital allocators. Sometimes it's subtle, sometimes it's overt. Unfortunately, at Recast, we've heard horror stories from many female GPs being asked any number of inappropriate questions, but one example of which is your age, which begs the question, what is the right age to start a venture fund? If you're too young, you're inexperienced versus younger men who are thought of as hungry in the space. If you're of childbearing years, you're distracted versus men who may have a spouse at home who can shoulder that responsibility. And if more advanced in your career, you're out of touch versus men who are experienced. So we've also heard from GPs of color that they're asked questions that imply the allocator doesn't trust the background that has been described to them, questioning the GP's honesty and integrity. The stories go on and on. I won't continue, but you see kind of where we're headed. As a result, in practice, I think emerging diverse managers often take significantly longer to raise their venture funds, and this extended timeline can exhaust a new manager's runway and momentum. So, given all these challenges, how can firms like mine that have established programs kind of address these issues? And what else could we consider here today, or what else could I ask you to consider given your very important role in the capital formation conversation? I think targeted support programs honestly play a vital role. They provide emerging managers with tools and knowledge and networks, all necessary to create opportunities for success in this space. I think our journey at Recast illustrates how emerging manager support programs can evolve to meet industry needs as well. We mentioned 2 programs that we have. When we founded Recast in 2020, we recognized the limitation of fund-to-funds. That's limited slots, right? There's only so many investments I can make a year, and there are so many more high-potential emerging managers out there today that we believe deserve to be in business, just need perhaps some additional support to overcome some of the challenges that I've described. And this realization led us to launch the enablement program in 2020, productizing that support I had alluded to earlier. Enablement was a virtual, tuition-free educational program for emerging managers in venture. It offers a structured 12-week curriculum offering aspects of firm building and fundraising, where my team can be most helpful, given our LP backgrounds. But session topics range from effective strategies for managing operations, improving the efficiency of your LP targeting, differentiation, how to stand out, among other things that are critical to that firm building process. We bring in GP and LP friends from the venture community, seasoned industry professionals to really highlight things that the managers can be doing, or avoiding common pitfalls and meet institutional investors' expectations. Each of our cohorts is roughly 12 to 15 managers at a time, where they have the opportunity to build a very tight-knit peer group, sharing experiences and supporting one another. Interestingly, while our enablement program addressed knowledge and network gaps, we recognized the opportunity to do more even just a few years after launch in 2020. At the time, there were a growing number of educational programs working to serve the emerging manager community. It became clear that the emerging manager community is kind of over-mentored and drastically under-resourced. So I think with our best of intentions, we were duplicating perhaps efforts that were already in existence, and we really wanted to change that paradigm. We also saw, as we've alluded to previously, that it was taking women twice as long to raise their funds, and even longer when you looked at the intersectionality of gender and race, or gender and ethnicity, or other underrepresented or disadvantaged categories. And in 2023, we launched the Accelerate program, building upon the success of our enablement program, but adding to it more robust operational support, shared services, and financial support to offset some of these firm building expenses. Because honestly, if this was the river that everyone was swimming in, we really wanted to provide everybody a better raft, something that was new and different. So with early support from Pivotal Ventures, a Melinda French Gates company, the program is really rooted in the hypothesis that testing a hypothesis really, that by increasing the number of emerging GPs that identify as women or non-binary, particularly those focused at the early stages of company development, you will also increase the percentage of VC funding going to underrepresented founders. I mean, clearly, with more diverse-led emerging managers in market, you could see a pathway enabled to more diversity in the venture community more broadly. So today, Accelerate offers a number of services to address the capital access and operational challenges that emerging managers face today. We mentioned this core curriculum, so today it's a 6-month program, meeting twice per month. There's in-house shared services providing no-cost support for critical needs. We've really seen it's Groundhog Day for many of the challenges that emerging managers are facing, right? And getting access to and understanding the landscape of appropriate service providers and frankly having a platform that they can go to have pre-selected support services that they can benefit from at no cost to them is really a driver for success. So things like investor relations support, pitch positioning, LP outreach, a set number of hours with a consultant as an example that they can leverage at their leisure as appropriate for where they are in their firm building journey. A VC document template library, why recreate the wheel? Why pay someone to recreate these documents for you when they've been available for a very long time? Fractional operational support, intern programs with vetted students or experienced professionals that can help these managers get that extra set of hands that they so desperately need. Office hours with legal counsel, et cetera. We still offer executive coaching, offering a chance for kind of that professional growth, strengthening your leadership styles, getting through interpersonal blocks, partner dynamics, things that, again, you wouldn't necessarily think or have access to with a resource-constrained firm. We also focus on peer groups where you can meet with a small group of 5 to 7 emerging managers at a similar stage to learn from one another, lean on each other, and frankly, it can be really lonely business. So having that kind of personal board of directors, if you will, to help you in your firm building journey, I think is really important. Other offerings are LP office hours, and then of course the financial support, $100,000 in operational support for each fund, and preferred pricing from a network of vetted service providers. To date, we've supported 61 managers through that program, and we've opened applications for our 3rd cohort that will kick off later this fall. There's always room to do more, but we're really pleased with the success of the program thus far. I mean, many of we call them recasters, have successfully closed their funds, some now raising subsequent vehicles. Some have used the program as a means to iterate, learn, adjust to market conditions, all of which we're very proud of. What began as an educational experiment really grew into a comprehensive model for nurturing the emerging manager community. And I think that our program represents kind of the success of similar high-touch programs, and we have peers that we deeply respect in market today that are also doing this work in one way or another, and excited to see kind of the growth of those vehicles as well as a way to lift up this community that's been so under-resourced for so long. Beyond the programs like ours and others that are working to kind of move the needle here, I certainly have some further recommendations for consideration by the committee beyond just looking at programs like ours to really move the needle, with the goal of course, facilitating support and capital formation among the emerging manager community. First is, I would say, encourage more adoption of a fellowship model. I think programs like ours can be replicated, scaled through collaboration. Large institutional investors, foundation, established venture firms can partner with programs like this to drive more awareness, making these programs more of a standard part of the LP community's engagement with emerging managers. It can not only drastically lower barriers to entry, but frankly, can really help mitigate risks of those investments as well if done properly. I think increasing awareness around alternative investment vehicles, and I think you all touched on in your last meeting kind of the role of fund of funds in the broader landscape of capital access. I think that's absolutely critical too, because as mentioned, some of these larger institutional investors simply cannot write checks directly into these managers, even if they want to. And so fund of funds is one solution. There are alternative solutions alongside it, such as separately managed accounts, bespoke platforms, but just I think drawing more attention to those as really interesting solutions to tackle this part of the market, I think would go a long way too. For a long time, fund of funds, I think, have had a difficult rap in the business. The additional layer of fees is something that many institutional investors are not a fan of. However, if done properly, the performance of those vehicles can more than outweigh that additional layer of fees. And in an emerging manager space, predominantly in venture, manager selection really is everything. And then if you layer in these additional support services, it can really help move the needle. Additional considerations, supporting public-private funding vehicles. Their access to capital is certainly the toughest barrier that these emerging managers have. So considering structures that directly inject capital into this part of the market, I think are really interesting options. Similar programs in place today certainly promote investing in small businesses, such as the State Small Business Credit Initiative. Of course, the SBA's SBIC program has also touched this space as well. I spoke briefly previously about the GP commit. I do think encouraging more conversation around the GP commit is a worthwhile effort too. The question of is it appropriate, how much should it be, is really nuanced. For some GPs, while 1% may feel astronomical and inappropriate given how much of their professional reputation is tied up in their firm building and the incentive alignment that creates, but also just their personal financial situation. In some cases, 1% is inappropriately small, right? I mean, I think it's important to look at the other side of the coin. If someone is, very wealthy and having the right, quote unquote, incentive alignment would mean a much larger GP commit is appropriate. I think so long as the percentage demonstrates alignment with the LPs, it should be focused on what means for thorough, responsible decision-making, right? That is the end goal of what the GP commit is supposed to represent. And I think being okay with stepping away from a one-size-fits-all is the appropriate path forward there. And then, finally, I would say reinforce the data on emerging managers. The biases that emerging managers are too risky to invest in is really outdated. I think, students of the industry understand the growing body of research that shows that emerging managers outperform. Not all emerging managers. Again, the key is properly selected emerging managers. However, data that's been published by PitchBook, has shown that emerging managers consistently outperform established managers since the late 1990s. Cambridge Associates has published similar data that shows that, over a 10-year vintage year period, over a 12-year vintage year period, the top 10 best performing funds by net TVPI, anywhere from 40 to 80% of those top 10 slots were occupied by emerging managers from any given year. So this notion that it's too risky to play here, or that it's only catalytic, this should be charity, any number of, phrases we all hear, it's outdated and we should move beyond it. I think the outperformance stems from several factors. They're beyond the strong alignment with your LPs. The hunger, the scrappy nature of building a firm. These are startups in and of themselves. I think is extremely compelling. And with the increase in funds in the market, maintaining a competitive edge is critical. So oftentimes you're seeing these emerging managers carving out like specific niches or specialized focus areas, which can be really great for driving performance and is really great for the founders that they support, right? More choice for the founders is appropriate. In conclusion, I think emerging managers face significant institutional barriers, of course, whether it's limited access to capital, operational challenges, persistent biases, but the mosaic of solutions that are needed to address these issues is broad and vast. I think the programs like ours is one key component, but there's certainly more to it, and I encourage the committee to consider how policy frameworks might better support emerging manager formation and growth, particularly around expanding access to institutional capital, some of the ideas that were shared previously, but really by lowering the historical barriers to entry, I think will enable kind of fresh capital entering the market, fresh perspectives, which ultimately benefits all of us through innovation, jobs, wealth creation, all at the small business level. And by supporting emerging manager programs and adopting enabling policies, I think regulators can help accelerate what I see as a very virtuous cycle in the venture capital industry today. More capable fund managers certainly leads to more choice for entrepreneurs, more successful businesses, and hopefully more robust economic growth. So thank you very much for your time. Appreciate it. Happy to answer any questions you might have.
Thank you, Sarah. We so appreciate that very thoughtful presentation. And as somebody, who's a member of the emerging manager community, I can firsthand say how much everyone appreciates and respects the hard work and innovation that Recast has brought to the space. So I'm excited to open it up to questions, and I would love to start with the first question. which for the benefit of the committee and, sort of the scope within which we can make recommendations. Could you talk a little bit about why smaller funds are so important for the economy versus, the landscape that we've kind of headed into, which is just a few mega funds, right, controlling a lot of capital, both from a startup perspective and an LP perspective,
Sure.
and how LPs can think about operating, or how they have to operate in a world where, one, they're being sold the narrative that the top quartile are always going to be the ones that outperform, and two, nobody ever got fired for investing in mega fund name here.
Sure, yeah. Now, there is a really interesting bifurcation taking place in the market. I think emerging managers, to me, represent venture capital in its purest form. It's kind of like what venture capital was when it started, right? I think out of necessity, many firms grew larger as they attacked multiple stages. Those vehicles were then, possible for larger entities as they, as pension funds entered the venture capital market, for them to be able to play. There was a necessity for larger funds to provide them that kind of venture capital access, and the multi-stage firms were a great way for them to do that. As they grow, though, I think there's exceptions to every rule, of course, but as they grow, it's, for many firms, the returns can become more muted because I think I alluded to this previously, but for some of it's just math. It's really hard to 5x a billion-dollar fund. And if that's your kind of return expectation in venture capital, that can be disappointing for some. However, some of the larger firms operate almost like an index of sorts. It feels a little bit more like a BlackRock than it does an early stage venture fund. But for some, that's a great way for them to gain that exposure. So there's a place for that. But I do believe that the smaller fund sizes represent kind of venture in its truest form. So you're looking at kind of these pre-seed, seed-focused managers where savvy founders are looking for investors with deep industry expertise, really unique networks and abilities to move the needle for their company post-investment. And those folks will win these very highly competitive allocations in those companies based on who they are, what they can do. And for a $100 million fund, as an example, to 5x, that's a very different math problem. There's more opportunities for them to gain access to the exit environment. I mean, we all know the vast majority of venture outcomes are M&A, right? It is not IPOs. Smaller funds have far more opportunities for exit opportunities, to drive meaningful performance for their fund, right? So an even modest outcome could be a fund returner for a $100 million fund. Modest in terms of, in the broader venture landscape, we talk about, unicorns, like that's the only thing that represents success in venture, and that couldn't be further from the truth. So that the flexibility that a small fund offers, not only for GP expertise and deep industry and investment thesis focus, but from an LP's perspective, having even modest exit outcomes drive fund performance means that you can see theoretically better outcomes for your overall portfolio. I think as you're building diversified exposure to the venture ecosystem as well, for some of these larger funds, one commitment that's a generalist, it almost feels like you're getting that, again, index exposure. But if you're trying to build specific industry sector exposure through your portfolio, you can do so through smaller funds more easily as well. I think from a founder's perspective, you just have the attention of, oftentimes you have the attention of the GPs. The expertise they're bringing to the table is highly focused and can really be impactful. Did I miss any part of your question?
No, that was great. Questions from the committee? Laura?
Yes, thanks. That was wonderful. Okay, I'll try this one. Ooh. I'll stand way. Okay. Okay, all right. So I was really fascinated by the data on the new fund managers or emerging fund managers actually having somewhat better returns in many cases than the established funds. But I wanted to ask a question. Is there any data on something you referenced earlier, which is funds that are run by women or underrepresented minorities, is there data that more of their investment goes to companies with underrepresented founders? I'd be very interested in that.
There is. I believe a number of studies have shown, I think Harvard has done some studies on this, Kaufman has done some studies on this, showing that I think women are twice as likely to invest in other women. So if a general partner that identifies as a woman is twice as likely to invest in a founder that's a woman. And I believe it was Harvard, but I'm happy to circle back on this data for anyone that's appropriate, that's curious. I believe it was for Black general partners specifically, they're 3 times as likely to invest in a Black founder, which, as when you look at network effects, that's why enabling this pathway for more diverse general partners is so important, because it really does enable a pathway to greater diversity within venture more broadly. And that's, I think, such a key component of the emerging manager conversation today.
He's very kind. Thank you, Bart. 2 questions. One is, you mentioned appropriately selected fund managers, emerging fund managers. First question is, do you have, kind of from your own experience in terms of what you have found as you kind of post-mortem the emerging fund managers you've invested in, kind of the profile characteristics in retrospect that you say, wow, I'm going to double down more moving forward on these types of emerging fund managers that represent these types of, characteristics in their career or personality or track record, whatever, to whatever extent the characteristics are with the profile. And then second question, you mentioned kind of the, problem of kind of big numbers, right, and moving the needle for institutional players. And you mentioned institutional bias, clearly one of them probably being, how do I invest to move the needle from a return standpoint, given the fact that I'm investing, the volume of dollars that I am. And clearly, even with this report that the office published this year and has previously, clearly kind of mega cap dollars are really kind of where, what moves the needle for the marketplace. So do you have any thoughts or recommendations in terms of what could be done to help move more institutional dollars to focus on emerging fund managers?
Sure, thank you. First, to your question on properly selected. So, my co-founder and I came together with some, as 2 institutional LPs that have participated in the space in a variety of different ways over the years before coming together to launch Recast. And so we both have individual experiences that we bring to the table, but coming together with a core belief that the best will fall within first of all, the 3 things I mentioned, right? So emerging, having that unique experience, and appropriately sized. So let's assume that the managers we're talking about are already in that camp. What we believe will drive out performance are a general partner or general partners, a team of GPs that are building a fund focused on an investment thesis where they have a unique expertise that they're bringing to the table. So, and it directly links to that investment thesis, right? So it may be their operational experience, it may be their investment experience in that area, it may be a unique network relationship they have with certain organizations, or any combination of the above that sets them apart, where they create a flywheel of founder referrals. We've found without that founder flywheel, you will never build a franchise. So you want the founder community, most importantly, but of course the community of co-investors and then later stage venture funds, and then of course limited partners to know this too, but most critically it is the founder flywheel. So do founders that are building companies in the space in which your firm operates know you? Do they, would they seek you out for an investment? It's incredibly hard to do that. But if you have, and that doesn't mean you have to have an investment background or an operating background to do that exceptionally well. Now, typically we see emerging managers don't all have the 10-year attributable track record from an established shop, right? So I think investors in emerging venture funds need to have comfort in diligencing these managers in a different way. I don't think that the traditional models don't necessarily always apply. They apply sometimes, but they don't always apply. And so while you're not necessarily investing in a first-time investor, right? There's been some investment opportunity, whether that be, personal angel track record or investment beyond their at a prior firm. But their operating ability, they were consulting with a variety of companies for advisory shares or whatnot. There's different ways to talk about this track record of selecting companies, right? And so that's a piece of the puzzle. And do those represent the types of companies that they would be supporting in this new strategy? So that's really important as well. We really see a few different archetypes. I think there's the rock star operator turned angel fund investor turned venture fund manager. They can be just as strong of investment opportunities as someone who's spinning out of a existing venture shop. I think that there's talk about kind of biases in market. I think in the investor community, there's a particular bias toward the blue chip spin out, right? Oh, well, they were at such and such firm. There is an incredible amount of risk to backing someone who's spinning out as well. We call it like the cape, right? Are founders wanting to work with you because of the name, because of the superhero cape you tend to wear, because of this big brand you represent? Or is it because of you and your expertise and what you bring to the table? And diligencing that can be tough. But there are phenomenal managers that have launched their own firms after spinning out, and there's others that's been more challenging. Also, starting a venture fund is building a business. You are a startup in and of yourself. And if you're used to having an army of analysts beneath you and a whole IR staff that's doing all your fundraising, and then you're sitting there now, you have to build it yourself. That can be a rude awakening for some. So you folks need to kind of go in eyes wide open, which is, that's an important piece of the puzzle too. So those are considerations. It is so nuanced. I hate the answer, it depends, but it does. It does. And then your second question, Vincent, was how do we get more institutional investors?
For example, like pensions, which we talk a lot about in different places.
So I think for some, they're so large that it's really hard to access this space, even through a fund of funds, even through a separately managed account. But I think the majority of them, it's possible through unique strategies like that, right? These intermediaries can accept a very large check and then diversify it on their behalf to multiple vehicles. And I think that there's been wonderful examples of that through the years of pensions that have been very active in that space. So there's definitely models there. It's just encouraging folks to take a look at what has worked before. And the performance of some of them have been exceptional as well.
Thank you so much, Sarah. I know we have some committee members that are joining us by Zoom. Herbert, I believe you have a question for Sarah. Yes, no? Oh, he did? Okay. Did he write it in the... Okay, let's go with Jennifer then.
Thank you so much, Sarah, for your presentation. I have a question about the 1% for the emerging fund managers, the 1% skin in the game. Is there any data on any alternative structures that would be an alternative to that 1% skin in the game that you've seen work that we could potentially advocate for?
So to date, there are... Well, issue number one is getting folks to accept things that don't look traditional, right? There have been over the years what are called GP commit lines of credit. So some banks, for like the bank for the venture fund, can issue a line of credit for that manager to leverage that for their GP commit, so commit alongside their LPs as the capital is called. And then you can use management fee offsets or depending on the structure, perhaps, future carry to pay that back. But even in those cases, I think the banks are underwriting the financial stability of that individual. And then, of course, the size of the fund. because in the management fee stream, of course, that you would be leveraging. So that's not, it's an option out there today. I don't think there's been a ton of innovation here, and there's certainly a lot of room for it. I don't want to dissuade folks from trying to create new products to address this. I do think the easiest thing is to just be more open-minded about the general partner and what their financial situation is and what's most appropriate for incentive alignment. Because a blanket 1%, as I mentioned earlier, is not appropriate for some well-established firms or individuals starting funds of a different means than those that perhaps are not independently wealthy.
Just to follow up on that, what about cashless GP commitments, which obviously include waiving a portion of your management fees to fulfill that
Yeah.
GP commitment?
Yeah,
Are those being accepted in the market?
Absolutely, and I'm sorry, I put that in the camp of the kind of like management fee offsets. But thank you for being more specific for me. Absolutely, I mean, you're seeing it happen for sure. It feels like creating more financial constructs to achieve something that is not maybe necessary. But I agree that that is an option.
Yeah. Heath?
Jennifer, this goes back to your question just a little bit. For those of you that don't know me, I'm Heath Morris. I'm the Chief Risk Officer for the SBA's SBIC program and all of the SBIR programs as well, so our accelerators. And I sit on our investment committee. I review, hundreds of investment companies a year who come in and pitch, and we're oftentimes referred to as, even though we're not an LP, we're looked at as the LP group basically. We have a new product, which I'm sure Bailey DeVries has went over in detail in past, right, with our accrual debenture and our fund of funds, right? One of the things to the 1% that we have done specifically, and we're starting to see that a lot more from our VC groups, is that we don't have to have the 1%, right? We would like that, and yes, to acknowledge that is the industry norm for sure. But if we look at it as skin in the game, right, to use Sarah's term, as long as we feel that the individual is putting in a significant commitment that is a large financial commitment to them, right? And again, it definitely depends. If you have a super large fund and you're unable to get the 1% because the amount would be more than we would ask, we simply wouldn't ask that, right? But there are opportunities where an individual, we would look at their financial situation, and to them, this is a lot. To them, this is them saying, we're all in, right? We've pushed all our chips in, this is all we have. No, we didn't reach the 1%, but clearly this is a significant financial investment for us, and there is no turning back, right? That's what we really look for, and we like to see that. We've also heard a lot of, VCs that say, if you can't get the 1%, yes, that is the norm, as long as we know that this is it for you, right? That you're fully invested in it. So I think trying to change that mindset a little bit to allow those individuals who might not have the connections or the financial backing or family tied net worth that can get into that arena, there's a way that where we start to model the mindset and look at those managers that can get in without reaching that 1% threshold. So just wanted to add that to your question.
Thank you. And I know we have, hopefully the WebEx working now. George, I believe you have a question.
Yeah, thank you. Sarah, thanks so much for sharing your expertise. Are you all able to hear me to confirm?
Yes.
Yep.
Excellent, thank you. Sarah, two of the things we are explicitly going to talk about a little bit later this morning, under the private fund registration, the qualifying venture capital funds, there's a $12 million cap in there. Are you experiencing that a lot of early emerging fund managers are hitting that cap? And then also under 3C1, the limit of 100 LPs into a fund. Are these common themes that people are running up against, and are raising those caps going to help emerging fund managers?
Yes. So I'll say the vast majority of the managers that we're seeing through our programs are raising between $10 and $30 million for their first fund. So the $12 million cap is certainly being reached by many. The 100 investors rule is such a challenging one, because if you've got a small fund who is, based on their fund size, really limited in their LP archetypes they can reach out to, so focusing more on family offices, high net worth individuals, perhaps corporates, others that are writing perhaps more modest checks, you need so many more of those modest checks to hit your $25 million target, hypothetically. So, are you going to hit 100 pretty quickly? I would think so. And there's plenty of examples of managers we know in our community where they really took that into account and had to think about the LP archetypes they targeted and in what order. And then we open up doors of questions about, obviously the limited partner community also feels a bit homogenous. And, if we're allowing other individuals that are trying to invest in venture, that want that exposure, want to build their own portfolios, but can't do so at a significant level, are you then going to arbitrarily be cutting out folks that you could then be helping to build access for? So I think it cuts both ways. I think it's important for the GPs to have more flexibility to be able to raise from a higher number, just in case that's the river they're swimming in. But I think it's also important from, the emerging LP community to be able to have access to wealth generation opportunities and venture capital. And if they're if they're going to be not have that opportunity because their check size as well, that's a challenge. So.
And I think, thank you for that question, George, because this is particularly relevant to our discussion this morning and our recommendation. From your perspective, what do you consider kind of a minimum viable fund size for an early stage venture capital fund? And what do you consider kind of like a very comfortable fund size at which, people could be probably have the budget to take on regulatory burden above that number?
This is such a difficult question because it really depends on the general partner's personal situation.
Okay, so just assuming somebody who, isn't independently wealthy, maybe, has to pay for food and rent.
Fair. So the solve to this, when it's smaller funds, is it's not their full-time job, right? So it's the proof of concept or fund zero or these terms you hear where someone's managing a $5 million fund while they're working full-time in an operational role, or their venture partner for a larger firm, something to supplement their income. I think the answer really depends. I would say that for a solo GP to have enough capital to pay themselves a competitive salary, and perhaps build out the back office infrastructure appropriate for an early stage venture fund, that minimum is 25. And then of course for multiple general partners, that's different. But if it's a solo general partner, that's probably where I would start.
Okay, thank you for that. Herbert, are you able to ask your question? Maybe he's gone. Okay, we'll go with Rose. And,
Well, can you
sorry,
hear me?
Herbert. There you are. Okay, we can hear you.
Okay, great. Hey, Sarah, thank you so much for joining us today. Very insightful information. I've got two questions. One is your accelerator focused only on female founders and GPs? And then the second question is, beyond any capital, are you providing any strategic access to strategic partnerships, the introductions to those who could be strategic partners, board members, and other VC, and making VC introductions?
Sure. Thank you for your question. Today, yes. So Accelerate, we launched with the support of Pivotal Ventures, a Melinda French Gates company, to focus on early stage funds that had that met a few different criteria. The first of which being U.S. based, U.S. focused. The second being the majority of a corollary of the first. At least 75% of your capital is or will be invested within the U.S. That the firms have at least one general partner who identifies as a woman or non-binary. So there can certainly be men on the team, but we're looking for funds that have at least one general partner who identifies as a woman or non-binary. And then we're looking for firms that have 25 million in assets under management or less. not including any SPVs they've raised or kind of like personal track record that they've developed, or any capital that they have raised in an open vehicle when they're applying.
Thank you. Bart, I believe you have a question?
Yeah, no, thank you. Thank you very much for speaking with us today. I am picking up on something that Stacy mentioned as one of the recommendations from the forum. I'd be curious as to what you think the role of finders, I'd say currently are, and then what they could be if that was, if the regulations on that were liberalized, and how that might affect the ability for emerging managers to establish a record. For intermediaries to maybe act as go-betweens between sort of the LP and even the investment community, and just kind of curious what your thoughts on that would be.
Would you tell me a little bit more about what you mean by finder?
So basically, folks that would get a commission on sourcing capital or sourcing funds.
Oh,
so,
like a placement agent of
yeah,
sorts? Okay.
and, currently defined as a broker-dealer,
Yep.
but finders, I think and Stacey can correct me, but I think the concept of it is, basically a non-broker dealer finder that wouldn't be subject to all the broker dealer regulation.
The concept of placement agents is very difficult, or finders or broker dealers, whatever term we want to use here today. It's a difficult one for the emerging manager community because of a number of limitations to that beyond regulatory. So just purely like execution, which is something I can speak to. The other pieces I'll leave to the experts. But execution-wise, placement agents are paid on success. So theoretically, the incentives are aligned. But if they're looking to place a large amount of capital into a fund, because that means they get a higher fee, it's very difficult to do it with a $20 million fund. It's not necessarily worth their time. Many of them also, the relationships are focused more on institutional investors, right? Larger LPs that, again, can commit. They're good long-term partners for the fund managers, right? So it's less turnover, but it's fewer commitments necessary to raise the fund as well, so a more efficient process for them. I think that you are seeing a rise of other models, so individuals that are operating more in a consulting capacity that have more family office and high net worth individual relationships and are willing to kind of be helpful in like LP archetype strategy and whatnot. But it's folks that have that network that's more helpful for emerging managers. So, but execution-wise, I think the traditional model's just been really hard.
Yeah, and I think it's a really good question too, because kind of technically VCs are the finders of companies. So, if you need finders for the finders for the finders, it becomes complicated. But thank you. I think we have time for one more question. So, Rose.
Maybe that mic. Right. So I want to go back and to some of the recommendations before this committee, especially around size, and if we assume around 25 million as a viable fund size for emerging managers, what I heard is because you're going more to the angels, family offices, you're going to have a smaller check size. So presumably you're going to need more LPs, and that's one of the recommendations is to increase that number. But the second burden you mentioned was operational. And so, can you talk more about how those tie, right? So we've opened up potentially access to capital by allowing you to go to more LPs, smaller check size to get to your minimum viable. But what is that doing to your management fees? What is that doing to the appropriately sized back office for your fund, right? Are they working against each other, or how is that facilitating fundraising and then actual deployment of capital for the fund?
Sure. So my suggestion around the 25 million as perhaps a level to discuss was taking into account that was including, assuming that the standard 2 and 20 model, so 2% management fee, which for many emerging venture funds today is actually looking more like a 2.5 to start. That is providing enough for competitive salary as well as for appropriate back office, like outsourced service providers. So addressing some of the operational issues I mentioned before, where the GP can focus on what they should be focusing on, but have really great fund administration, have really great tax audit, operating support as necessary, legal support. Key considerations also include fund expenses. So there's a number of fundraising expenses, legal expenses that, depending on how the LPA is written for a fund, can be charged to the fund, so it does not burden the management company in the fee stream, which also helps the argument. However, that means less investable capital for the GP, and if everything's riding on performance, I don't mean to take that out of one pocket, put it in the other, but these are the levers we have, right? But I think even at the 25 million, you've got the fee stream you need in order to cover those expenses. So many folks are not raising $25 million funds, though, right? So there's still going to be this issue of what happens for those folks that are bootstrapping a fund that, they're putting more money in. Not only are you not paying yourself anything, but you're going in the red because, you believe so deeply in your idea, and you want to see it come to fruition, and many of them are successful. So,
Eric,
Thank you.
can I just ask one quick follow-up?
Okay.
When you're saying so many are not raising 25 million, is it because they're hitting the current caps, or regardless of caps, they're not able to access LPs that will fund 25 million?
I was referring to the latter, not the former, but I think both are true. And there's this gray area for many fund ones or proof of concepts, fund zeros, whatever, where folks have started, they set out to raise a certain target, don't hit that target because the market has been crazy the last few years. So they're forced to operate at a suboptimal level. They find themselves, just kind of strained in how they build that. And those instances are going to happen, even if you increase it to 25, right? I mean, that will happen. There will still be folks that don't have, they have exceptional operating experience or exceptional, kind of founder access, but don't have great LP networks and just don't raise what they were hoping to raise. And so, kind of going back to the beginning of the conversation, hopeful that some of these other support mechanisms can help bridge the gap.
Well, thank you so much, Sarah. Your presentation and discussion with us today has really been invaluable. So we want to thank you very much for your time. I know the entire committee appreciates it, and I want to thank everybody for the very thoughtful questions. I think this is going to be extremely informative to our discussion this afternoon.
Thank you very much.
All right. I'd now like to introduce and welcome Ashok Kamal, Executive Director of New Fund Venture Group, a San Diego-based early-stage investment fund created by and formerly known as Tech Coast Angels, San Diego. Ashok is an investor, speaker, and social entrepreneur with a wide range of experience starting, leading, and investing in organizations in the private, public, and nonprofit sectors. Ashok?
Hi, everyone. Thanks for having me here today. It's great to be listening to some of this.
Now we can see you.
Hopefully everyone can hear and see me. Thanks for having me here today. It's great to be in front of this committee. I've been listening, and Sarah really covered very comprehensively a lot of points I would emphasize, so I'll sort of dial in on one of them that has been part of the discourse over the last few minutes. But just a little bit of background on myself. As Erica mentioned, I'm coming from an entrepreneur's perspective, born and raised in Boston. So I am not with you on the East Coast today, as I am in San Diego, my now new home, but I'm very familiar with the DC, New York, Boston area, and spent a lot of time there, where I grew up and had the bulk of my career before moving to San Diego. And that, in my experience, included running nonprofit, starting a number of tech companies, and then transitioning into angel investing myself when I moved to San Diego, which is what led me into what was then called Tech Coast Angels San Diego, a sort of typical angel capital association style angel group with 60, 70 members. Fast forward to today, there's 325 members of our group. These are all accredited investors, now around the country, although about 75% of our footprint is in Southern California. both members and companies. That's changed a lot over the last 3 or 4 years, even pre-COVID, as we started opening up our scope and becoming New Fund Venture Group, which the name kind of implies is different from an angel group and different from the one that we were sort of spawned from, different in a few ways. One, we have a fund first model. So we created a unique venture style fund that is raised completely within the group. So it's sort of a private syndicate raised into a fund vehicle once a year. So it's an annual fund, and then deploys capital based on a voting mechanism by the members, not by a GP or an investment committee. There is an investment executive committee that does the auditing of the votes and making sure we get our taxes done, et cetera. And I'm part of that committee, but the investment decisions are made entirely democratically by the members of the fund. There are 249 members of the fund. I think that's the main issue we'll talk about today as far as a rule. But that's a unique model. And we're deploying 10 to $15 million a year in totality, both from our fund, which again is leading the investment from the group, but it's not the exclusive source of our investments. We also do direct investment placements and then sometimes create parallel special purpose vehicles to invest in the companies that are all being diligenced and negotiated and decided upon through a streamlined process. So the types of companies we invest in are your typical venture field. For example, the last few, one is a CRISPR gene editing company that is making male mosquitoes infertile. We're excited about that one. The Gates Foundation actually was another co-investor in that. We just invested $1.3 million into a pan-cancer drug development company based here in San Diego. Last year, our biggest investment was in a coffee roll-up company that takes small regional brands and brings them all under one roof and hires formerly sex trafficked workers to do the majority of the work, roasting and delivering, and now mostly through e-commerce for that company. So those are just some examples of the types of companies that we've invested in. But we feel like our mission is not only to make money, but also to make a positive impact in the investments that we're making. I think the main reason that I'm before this committee today, and I understand that there's already a level of agreement and consensus on this topic, but maybe from my perspective, more sharing how the effective cap of 249 members in the LLC type fund that I'm running as an investment club impacts our group and therefore has a trickle down impact into the types of entrepreneurs and communities that we would be deploying capital into. We have, as I mentioned, well over 300 members of our group. Again, these are accredited investors, so it's not a debate over who should be accredited. It's per the existing rules. And we have 249 seats in each of these funds that we raise once a year and then deploy. We're in our 7th vintage now. The funds are also working. The early data shows for what it's worth. So Carta has been releasing data on fund performance. Our first 4 funds, so that's going back to 2019 through 2022, are all in the top 10% of the benchmarks per Carta's data in terms of DPI, so cash on cash distributions. Our first fund, the 2019 vintage, has returned all of its capital and more, which I think puts it in the top 5% of, and this is all venture funds studied by Carta in that data set. So we feel like the funds are, working. Of course, the results are early, and this is a hard business and a volatile market. So I'm careful to not overstate, but against the benchmarks that we have available. Because we have more members in our group than seats in the fund, we actually have to stop some of our own members at the door from being able to participate in the funds by their own group. What that means is we have a period of time where we run the capital call. Since again, these are annual funds, it's usually 6 weeks or so. Typically it's on a summer cycle. It happens to be we raise the subsequent fund when the current fund fully invests. So what does that look like? In July of 2024, we began raising the current fund. We stopped raising it in September when we hit the SEC cap for seats. Same thing the year before, same thing the year before that. The funds didn't start at this size. The first fund was a little over $2 million, but they've grown in popularity and in size within our group. So now we're in the fourth consecutive cycle where we've had to stop taking money from within our group as a result of the cap. And then once we fully deploy the fund, so that typically takes 10 to 12 months, as they're designed to be annual funds, then we raise the next fund. So after a period of, let's call it 6 to 8 weeks of a capital call within our group, we stop taking money and then we focus exclusively on deploying that money. That means that members who weren't able to access administratively the call during a period of time, because there's all kinds of reasons you can imagine, from health to family to being off the grid at the right time. There are people that don't have liquidity necessarily to invest whatever the average amount that they would like to invest in at a given point in time would be. There are people who haven't yet joined the group, but join the group after the capital call concludes, that then are kept out of that fund cycle for a period of, usually it's an average of, let's say, 6 to 8 months, where they can't participate in the fund that's investing money in their group. So there are a variety of reasons for which, on average, 20 to 25% of our group in a given year is not able to participate in our annual fund, even though the annual funds are designed to be entirely democratic and deployed, giving everyone in the group skin in the game, and therefore working on these deals together, sourcing, diligencing, making decisions. That's the nature of our group. So the fund cap is the only thing that is preventing, let's say again, 20% of the group in a given cycle from participating in the annual fund. The AUM cap is not where we hit a wall. So I believe it's $12 million. I think it was increased per one of these funds. Our funds are typically in the $7 million size. So increasing the assets under management, as they've been increased now, did not have the impact of changing the size of our funds, because the average investment from the 249 people in the fund is about $25,000. The range is $10,000 to about $300,000 for any given fund, for any given member who's buying units in the fund. It's the number of seats. One of the main reasons I think the number of seats is maybe even more important than the cap on AUM is we have obviously debated increasing the minimum investment threshold into our funds, because that would then prioritize people who can write bigger checks within the group. Again, these are all accredited investors who are capable of writing checks, but some people want to write $10,000 checks, some people want to write $100,000 checks. But we haven't done that because, and I think, I would emphasize a lot of the points that Sarah was making. New Fund is an emerging manager, for what it's worth. We're in the seventh, one of these fund cycles, and everything about the organization has changed significantly and structurally from, the origin organization of 15 years ago. This is an emerging manager, and we want to have a low friction on ramp for people that want to get into the venture investing asset class. So we've kept our entry point at $10,000 because that allows us to have a wider scope of members who can participate in these funds. And therefore, we're able to achieve greater diversity within the group, diversity of all kinds, which is very important. And Sarah talked about a lot of the data as to why that's important. So that's one reason that we haven't increased the minimum entry point. Another reason is we found that people who start at $10,000, which is again the minimum to invest in one of these funds, that's never changed, even though the funds have tripled in size, is we find that people who participate in their first fund often tend to level up, such that by their second, by their third cycle, they're investing more after they become more familiar with the group, after in many cases they become more familiar with venture investing, since this may be the first type of venture investment that they make. I know myself, when I got started in 2016, doing angel and venture investing, I used platforms like AngelList that were, very novel at the time, still, somewhat novel to dip my toe into the waters of angel investing, as opposed to writing $25,000 and $50,000, checks into single companies, the sort of classic angel model that was more prevalent then, but is still, in existence today and didn't work, for me at my stage in life. So we want to have that big tent for emerging angel and venture investors as a emerging venture fund ourselves, and therefore we haven't changed the minimum investment level. But the effect is, of course, we have then continued to hit the cap for the number of seats that we have, and we're butting up against it every year. Fortunately, it was increased, I think, in 2018 from the 99 effective cap in an LLC to 249, which, has that was timely and fortuitous for us in that it allowed us to be able to grow the funds from the $2 million starting point. The first fund had 112 members in it, to give you an idea. So it would have been maybe a little bit under $2 million if it had been a cap of 99, but we wouldn't have been able to grow it in the same design, let's say in philosophy that we have today. So from my perspective, increasing the cap, whether that number was 500, certainly 500 would accommodate new fund today, as we are formed. But I don't know how long it would accommodate a fund like New Fund for, in the future. In that, I can tell you, we've had conversations with other venture organizations that have looked at partnering with us or even joining New Fund, under this national banner. And we've had to pause those type of conversations because we just don't want to compound the problem that we have right now of having a surplus of investors, but not enough facility to be able to give them the opportunities that we want our members to have, and therefore have purposely not grown our group over the last couple of years at the rate that we could have. So I think if the cap was raised to a number like 1,000 or something even higher than another 10%, 20%, then that would also give us the opportunity to think about growth, again, market permitting, because it's been a challenging market as well. So a good time for us to slow our growth, which was fairly exponential, from 2021 to 2023. So that's an issue that I think I appreciate hearing that the committee is already taking into consideration for recommending changes in. And I can tell you, as someone who deals with it firsthand and has dealt with it for several years, it would make a big difference in us being able to bring more capital into the group, deploy more capital into the types of companies that we're talking about, and hopefully have much more impact that benefits all of us.
That's great, and would love to open it up to questions from the committee. But first, would love to get your perspective on what, just so that we can really understand. You've purposely decided to stay within the registration exclusion pathway. How has that benefited you, and have you sort of weighed what the impact of registration non-exclusion would have been on your organization and why you made that decision?
Yeah, I think we've had to weigh all the options to some extent. Given that when you have a problem, you have to look at solutions. Given the origin of our group, which really started as an angel group, and the structure of the group, the fee schedule that we have, the culture that we have, we're not a VC, and I think New Fund doesn't aspire to be a VC. We are a venture group. It's sort of a model that we've been developing and now honing. It would really change the nature of the group to then go into that more centralized, kind of institutional, purely model. And we think what we have is a little bit different, and it's one of the things that attracts people to us, in that they're able to have influence, they're able to participate at a level that's comfortable for them, and they're able to take part in a organization with a culture and a very inclusive philosophy, which would change if we were to then need to go through a number of other um, regulatory compliance kind of standards, both the amount of money that we would need to then take in fees to be able to facilitate and be compliant would change. And I think it's just we'd rather stay small for now than try and go big, and then, be in a slightly different business with other people that are already good at doing that business.
All right, great. Marcia?
I'm just curious, out of the 249 then that you have in each of these annual funds, what would you say on average is the participation rate of the people in the fund? Are they participating on a pretty much, do you have like the core group, like the usual suspects that are kind of like there all the time who are doing a lot of the heavy lifting? Or do you have people that kind of come in and out of that?
Yeah, there is a core group. So in our seventh vintage now, there are a number of people who are in all 7 of the funds. They've been there since the inception. I always joke, you get your steak knives after, you finish your, capital call, for your consistency. Um, the core of the group is probably 50%, of the folks that have rolled over from, let's say 2 to 4 consecutive annual funds, and then, about half that have joined the group since, the prior or 2 fund, vintage prior cycles, kind of had included. And there are always new people coming in totality, because, we have 325, like today, active members of the group. And, again, this is a single organization. It's not a franchise, or it's not chapters. It's New Fund is New Fund. It's one group. It's about 70 to 80% of the people that are able to participate in a given annual fund. It doesn't mean that the other, let's say 25%, would want to participate in a given vintage, and that's totally okay. There are people, that say to me, I like to make my own mistakes, make a lot of mistakes. I think my stream.
Yeah, it was just for a second. You can
r-
continue. We can see you.
Yeah, so thank you. I was saying that it's not to say that everyone who's not participating in, let's say, this current vintage wants to. There are some people who are holdouts, from the beginning. And one of the quotes I've heard is, "I like to make my own mistakes." And as an angel investor, Marcia, we make a lot of mistakes, have to take a lot of shots. But there's definitely a non-trivial number of the people who aren't participating that would be, if they had, if we had more seats, and if they had, maybe more time to be able to join. And then there are a lot of people who join the group after the fund capital call ends, who are just locked out until, the next fund.
Bart?
Just sort of curious, the compliance costs that you do have to face, could you sort of say what those are even as a exempt fund? And then also curious if since it does sound like you're going multi-state, if you run into any challenges operating across multiple state lines.
We haven't run into any challenges, yet. We do file, Form Ds with, all the states. Maybe a given fund might have 10 or 12, or so states. It's, concentrated in California, for sure, but, that's probably a typical number. So, we file our Form Ds. We obviously, do our tax returns, and we issue K1s, but that's, more for with each of the members, every year. But it's certainly significantly less than if we were to classify differently. And what that allows us to do is keep our fee structure low. So the cost to be a member of New Fund annually, and this is be a member of the organization, which is a 501c6, is $1,800 a year. That's a pretty standard due structure for an angel group. The fee structure for the fund is 5% carry and 3% one-time expense holdover that we use to pay the fund's specific expenses. So that's the, setup for legal, the annual tax work, any other, administrative work around distributions, et cetera. So the fee structure for the fund compared to, say, a 2 and 20, which obviously when you are running a venture capital fund, does make sense, and it's, accepted within the industry. But our fund is actually a 3 and 5, and that 3 is not per year. It's one time at the beginning of the fund to pay for the fund's, expenses in its 10-year life.
Jennifer, did you have a question?
Thank you. You mentioned that for members who are, who missed the capital call or who are locked out because of this threshold, do you find that once, that they have to go through that period where, they have to wait, that they lose interest or, they become cold? And are you experiencing drop off or attrition with like trying to eventually keep those members on?
Yeah, that's a really interesting question. I think, something maybe for us to try and identify more in the data. It wouldn't be obvious at the surface level, which is one of the reasons I think that would be interesting to find out, because we don't have a high dropout rate in general, and those people who you mentioned are still joining the organization before they're participating in the fund. So they're joining new fund, they're paying their $1,800 for the next 12 months. So they already have some kind of skin in the game, and then orientation. I think what we find is that they have a higher level of participation when the fund actually opens up. So as opposed to getting fatigue, they tend to become almost anxious to participate in the next fund. And I think where it creates the conflict is with some of the existing members who then, there's a bit of a feeding frenzy, especially in that, first 2 weeks. We find we raise, usually, like last fund, we raised $2 million in the first 2 days, within the group. So I think what it does is it creates sort of an anxiety for those members to make sure that they have their seat when the next fund launches. Although I think it would be interesting to find, I wouldn't be shocked if there were some people who leave the group entirely because they just never kind of got fully engaged, and then life happens and other priorities come up, and as a result of them being on the sidelines, they just decide to do other things. I'm sure there are cases of that, if we could really drill down into every year's attrition. So it's a very interesting point you bring up. Thank you.
Rose?
Thank you. I'm interested in this concept almost of the emerging LP and the rationale for keeping that minimum check size small. In these funds, what is the average check size of the folks that are participating? You mentioned that they, scaled up from your 10,000 minimum, but you have this core that is a repeat participation. So, across the last several funds, what has been that average check size for this group?
Yeah, the mathematical average is about $25,000 to $26,000 if you took like a 3-year, look. Most people invest in the $20,000, kind of, range. And then there's a lot of people who invest, $10,000. A lot of those people, for what it's worth, also do some of the most work. So another reason we've kept the entry point low is we find that even if they're investing, initially or, for some period of time, $10,000 or $15,000, they are also doing a lot of the heavy lifting in terms of, due diligence, which is one of the reasons we, value those people.
George?
Yeah, hi. Thank you for sharing, Ashok. I'm curious, are there other angel groups that you talk to or that you come across that are already doing a similar model, or maybe striving to do something similar? And Marcia, maybe if you have a perspective on that as well, I'd love to hear. Is this kind of a one-off, kind of unique perspective, or is this kind of where the angel industry is moving?
Marcia could speak, I think, much better to the industry as a whole. I can certainly say that since the time we started our fund, many more angel groups also have their variations of funds or SPV syndicates, and the ACA publishes a report that has the exact numbers on that. Certainly, it's gone up. I think our exact structure of fund is unique. We created it, sort of franken-funded it from a number of other models. We have shared the playbook with dozens of other groups and syndicate leads that have asked for it, and we certainly welcome kind of the sharing of what we're doing, and the reconfiguring for whatever group or community can use some of the bones, and I have seen some manifestations and have done many dozens of calls with different group leaders, not only sharing the playbook, but also answering questions and sharing, any feedback that I can with them. So I think versions of what we're doing are happening. I think the the hitting the cap issue, since we started our fund, in 2019, so a little bit earlier, is something that, becomes more of a problem over time if you're also growing your group, which we've been doing. So maybe some of these other organizations that are also emerging, maybe starting with the fund, hurdle and overcoming that. And then if they continue to, build their groups and successfully, manage the money, they will also work their way into then the issue of how to accommodate, the interest, that they have for the funds.
I'll just add that definitely I've seen, because of investor fatigue, that there has been more of a demand for an annual fund. I've seen more groups put annual funds together. What's interesting about what Ashok is saying regarding his group and the hitting up against the minimums that we're gonna, or maximums that we're gonna talk about, is since COVID, or I should say before COVID, we really didn't see a lot of national groups. It was all, oh, if I need to be able to drive to the, the old saying, like you had to be able to drive to see the investor get home or the entrepreneur get home by dinner time. So it was very regionally focused. And then COVID hit and we started to become much more national. So I know people here on the East Coast that are members of New Fund. And, I'm seeing that more and more. Queen City Angels out of Cincinnati, Ohio is also becoming a national fund which now has, I just read the other day, 22 different states involved in the funds that they do. So, I think this is becoming more of a prevalent problem because we have gone into a more national type of situation.
Yeah, and I think on that note, thank you, Marcia. I actually had a question around, if you could give us some more insight as a committee into the impact of New Fund on the San Diego economy. So, are you deploying this capital nationally? Are you deploying it into your local community? And if so, what do you think the impact of that has been for folks to know that there's a local resource for startup capital?
Yeah, thank you, Erica. So I'll speak to San Diego, but you can extrapolate, in your mind about the type of impact that we then want to export into other ecosystems, both emerging and established. But from the San Diego perspective, and again, I've only lived in San Diego myself for 9 years, but we have very deep and rich ties with all of the sort of producers of innovation activity, talent, research, et cetera. So in San Diego, that would be, the UCSDs, the SDSUs, the USDs, the research organizations, ranging from, Scripps to Sanford Burnham. San Diego is a very robust scientific and innovation economy, and that also extends into some of the most successful companies here, and that's the Qualcomms of the world, the Illuminos of the world, where we have many dozens of people who come from those organizations, and we work very closely with all of those types of groups. So we have supported both capital first and foremost, but also through mentorship relationships and other partnerships on events and community-wide efforts. Like Startup San Diego would be an example. That's sort of the social fabric of the San Diego startup ecosystem. I was on one of the first boards there. I got off boards once my wife got pregnant with our first child, and I have 3 little ones. So I'm not on that board anymore, but still a friend of all of those folks, and we're very involved in all of those startup catalysts. Then in terms of the recycling of some of our successes. So 2 years ago, one of our companies that we were a pre-seed investor in, DTX Pharma, got acquired by Novartis for $500 million, cash up front. A second helping of another $500 million that's kind of based on milestones. So this is typical in that kind of a pharma exit. But that was a company that we mentored, as a group. So the individuals who were responsible for that, while they were at J Labs, an incubator, that's here. then had a member join as the COO shortly after, our first investment at the pre-seed level in the company, and then worked with the company all the way up through its exit. I guess it was 5 years later, a $1 billion, unicorn exit, which then in the, 6 months that followed, spun off another, I think, 6 people who were one way or the other involved in DTX Pharma at, different levels, not founding, who then became, members of our group. So that's the kind of, virtuous cycle that, we hear about, of course, so much in the Bay Area and, some of the other, major ecosystems. But I've been in San Diego now long enough to see, a few cases like that firsthand, that just add swagger and talent, and kind of increases the velocity and the enthusiasm for startups and the venture and innovation ecosystem. And that's a model that we're now working on exporting to other ecosystems, around the United States strategically, and rolling out into places where we feel like, kind of our infrastructure and our culture and the kinds of deals and communities that we work in, aligns, from San Diego into, new places like Austin, Texas, for example.
Could you talk about a little bit about the importance of having kind of an independent local capital infrastructure for local economies in the face of a rapidly changing sort of economy and technological environment? How do you think, making sure that organizations like yours exist and are supported is critical to providing local communities with autonomy around their economic destiny?
I think it's really important, because I think, when you're talking about startup formation, there is, a, very high touch, kind of nature, to, the co-founders, being together and, going into this battle together, and then building a bench, of, advisors and mentors and, capital, around them that's able to engage, kind of very directly to help get, through those initial, 0 to 1, kind of hurdles where, a chasm that, obviously most people and most companies, can never cross. And I think most of the time that's done, kind of in a hyper local, nature. Then I think where things grow and evolve, is when the, broader stage of resources can become more important than that. For example, Drata is one of the, current San Diego unicorns, and, we have members who work there, who are in our group as investors, but they raised most of their venture capital from San Francisco, and that's perfectly fine. The founders were second time successful, founders, and they had this network of, tier one VCs who, you know, capitalized the company from the inception. That's fine. But they're an exception. Maybe there's a lot more of those founders that are toiling at UCSD and the research labs, and we're there, kind of having a presence. A lot more founders that are working on their bootstrap companies and one place or another. And I think when you have that access to local talent, capital, and people who care, which is really paying it forward, the fundamental underlying ethos of a healthy startup ecosystem, that's one of the most important cultural attributes that we can all be working to foster together.
Rose?
I'm curious if you think increasing some of the caps, allowing more members to participate and potentially expanding the geography, what impact, if any, would that have on the hyper-local focus of some of these angel groups today, including yours?
Well, I like to think of our model as kind of a cluster of grapes. So, we've built a vine, which is sort of the backbone, the infrastructure. It's our technology stack. It's, kind of our base level of resources, our management. It's, it's our board, et cetera. That, it's our operating model, that, is able to effectively invest in, now not just San Diego, but, 25% of our deals or what have you being, outside of Southern California. So I think we've sort of optimized for our local ecosystem, here in San Diego. And, now we're looking to leverage that, into other ecosystems where, rarely will you hear from founders there's too much capital, in living in city X. It's always the opposite. There's not enough, especially early stage, risk capital. And to some extent, that's true. I mean, you could 10x the amount of capital in some places, and it wouldn't 10x the number of great companies that come out of it. So there's a point where there's an efficiency, and part of that job, I think, of ecosystem builders is to try to convert, as many of those companies that have potential, into successful companies as possible, because some of it is then the help that they get, right. So I think at a certain level, there's a focus on your local ecosystem and being supportive, but it's not mutually exclusive. And then it comes to a point where having broader reach is actually additive for the local ecosystem as well, because then you have access to new investors that are in other places. You have access to talent, could be even remote. You have access to companies that are strategic partners, and I don't think a hyperlocal focus is something that will really work for any early stage investor, or entrepreneur, in the economy that we have today, and I don't think that will change.
Well, thank you so much, Ashok. We really appreciate your insights and input to our discussion, as well as Sarah. We also really appreciate you sharing your information and experience with us. So I want to thank both of our speakers today. It's definitely contributed to a very enlightening morning. And with that, we would love to dive into our discussion on our findings and potential recommendations. So as we discussed in our prior meeting, many private investment companies and emerging funds rely on one of the exceptions from the definition of investment company set forth in Section 3C1 of the 40 Act to qualify for an exemption from registration. Unlike larger and institutional investors, who often face difficulties investing directly in smaller businesses and early-stage entrepreneurs due to minimum investment requirements, angel investors and other smaller funds are often able to provide meaningful direct impact and capital infusions to early-stage companies. Additionally, emerging fund managers and early-stage investors often play an active role in mentoring and advising their portfolio companies, as we've heard from New Fund. We heard from Stacy that first-time and regional funds are declining in number and size, and so as a committee, I think we need to be thoughtful in considering ways to help support maintaining a variety of funding sources for the benefit of the early-stage companies they invest in. As we heard from Ashok, for angel funds, the ability to pool more investors and accept smaller check sizes, especially to let people get started, is critical, both to the financial viability of their funds and organizations and to generating larger capital raises that can allocate more and larger investments to portfolio companies seeking to grow. We've also heard that some funds, like his, are oversubscribed, turning away potential investors due to the limit on the number of beneficial owners per exempt fund. Ashok's presentation provides context for us in deciding whether the existing caps on the number of beneficial owners, both for traditional 3C1 funds and for qualifying venture capital funds, make sense, or if changes to these thresholds might result in more capital formation. We've also heard how the current qualifying venture capital fund size of $12 million might be too low for a financially viable fund, considering operational costs. This threshold was something that we raised and discussed during our prior meeting as well. And on that note, I just would love to direct everyone's attention to our wonderful one-pager PDF distributed to members, which highlight the relevant draft congressional legislation 3C1, and would love to first have a little bit of discussion before we dive into some specific questions on potential recommendations. Does anyone have thoughts?
Well, it does seem from the totality of the input that we got today, which I thought was outstanding. I actually thought this was a really, really good session. It seems like the number of beneficial owners is more is more limiting than the total amount of capital raised. So it seems like if that threshold were increased, then the number of funds who could actually form and then have an impact would be greater. The 12 million may be limiting from the standpoint that we heard that, having 25 million in assets under management allows you to kind of keep the ship afloat. And so I think the committee should also consider recommending an increase there. But from the totality of the input, it sounds like the most important thing would be to increase the number of beneficial owners that's allowed.
I agree, and we also heard about, market trends of the consolidation. So I think there is value in keeping a spread of distributions amongst venture and venture capital funds. And so looking at the committee's prior recommendation and, legislation, it really brought both the beneficial owners up as well as the amount. And so I think definitely continue. I think that 600 still remains, viable, and if there's hesitation, probably could bring that 150, down, because there is a point at which maybe they do want to become a registered under the 1940 Act because those economics. But I agree. What we heard is the number of owners, but I think it's going to be north of 25 million. North of I think in today's economy that's minimally viable, and we have to allow some room for growth in that economy, whether that's all the way up to 150 or somewhere between.
In the true spirit of our committee, which is about small business capital formation, I was really encouraged to hear Ashok say that by keeping his minimum at 10K, that was actually encouraging people to come in so that then they would come in for bigger checks down the road. And, at first when he was talking, and I know, the fund pretty well, I was just like, why don't you just raise the minimum? Because, then you wouldn't have the problem of all of the other members, wanting to get in, and then just let them do, sidecar or whatever on the side. But his argument was really good that, to keep it at the 10, you get the participation of people coming in at that lower level. And so, it just makes sense for us to have, the minimum of this, 249 raised so that they can do that more and really start to encourage. And I do think there is going to be a trend toward more funds like this with the amount of groups that are going more national.
Wendy?
Thank you. I'll try to remember to turn my speaker off when I'm done. This is all very interesting to me and quite new, actually. And I can't help sitting here, and I think Ashok did a really good job of trying to deal with unintended consequences, because that's always what I try to think about when we're trying to do something on this end. How does it impact the other end? And so the question that you had asked about if you raise some of these numbers, do you take it out of the communities? And I think, somehow in our conclusion, we have to make it clear that it wouldn't. Because I think that's really, because I do think that's really important at the angel level.
I think it's important not just at the angel level, but also at the emerging fund level. We heard, I think Sarah's phrase was the founder flywheel, that unique, niche. And so that can be at the industry level, that can be at the hyper local level. And that is why I drilled down into that check size and use that emerging LP, because when we think about having access to capital, if we now have, folks that are able to write smaller check sizes to participate in this economy and they're moving up, now we're sort of creating that next base level of LPs, and it's just going to flow through the community and open up access, as opposed to, okay, the way to solve this is now you have, a 50K. I mean, so many of these funds have very large, usually six-figure minimums to participate, and that's going to continuously lock out access, not create and introduce new people into the system and wealth generation.
Heath?
I wanted to add a comment that I think is really important to the point you all are driving home, and that is you don't want to abandon a certain line in the market, right? And so one of the things that we find really interesting about the SBIC program is specific to where it relates. I'm looking at the 50 million, right? If we have 50 million to close and then we're going to give 175 million in leverage capital, the goal of the SBIC program when it was written right back in the 50s was to bring in funds and grow them out of the program. More often than not, because anyone that's ever worked in private equity knows, it's like a high school, right? Everyone knows everyone, and your connections are your connections. Most people that are in their particular niche area don't want to abandon or leave that area because of their network, right? So when we talk about would they want to go, more often than not, our small business investment companies stay. Even though they have the ability to go, they intentionally stay. And we have these same conversations about, do we want to raise? Do we want to make it to where that they can remain here without graduating out? Are we going to abandon the market, right? I just wanted to give a little bit of, I guess, clarity or added, emphasis on the fact that the people that play in these areas, like the individuals we just heard from, they're well connected in that area and they know there's a gap there, right? And we've also seen with a number of other regulations where, with SVB and a number of the other banks that have went down over the last couple of years, there's been an increased requirement in large banking, right, to overcapitalize. And so there are a lot of market participants that are now gone, right? And it's created an even bigger void. It's created an even bigger incentive to participate and actively actively compete in these lower middle markets. So my thought is, if there is a fear of would they leave, that's a fair assumption, but I also would encourage you to think too that there's likely going to be a strong amount that stay because of that network connection in that specific area. We've seen that proven year over year in the SBIC piece. So.
All right, great. So, I just want to point out just to make my own comments as we're considering a recommendation, there are a couple of things that are standing out to me. One is that, we are quite interested in supporting increased participation in and creation of small business capital formation, which leads me to focus a bit more on the qualifying venture capital fund definition versus the traditional 3C1 fund definition, which, I personally don't know that we necessarily need to play with. But within qualifying venture capital fund, there were a couple of numbers that I heard today that I think make sense to me if we're going to move forward with some sort of a recommendation. Ashok mentioned, that he's already constrained by the 250 beneficial owner cap, which makes sense for an area like San Diego with lots of people and lots of potential members, as well as the very generous decision he's made to keep the minimum participation check size low to open up access to a wider number of people who'd like to dip a toe in. I heard him say that, 1,000 members would be a number that would provide him more degrees of freedom to operate his model. And to me, that made a lot of sense. So on beneficial owners, it seems like 250 to 1,000 makes sense. I also think as we're going, looking the increase in beneficial owners, an increase in the aggregate capital cap also needs to happen. And there was one number that I heard from Sarah that I think gave us some good insight. As a fund manager myself, I agree with her on the number, which is that 25 million is generally the minimum that you need to have a financially viable fund. One thing that she also gave as additional context, which I think is important for us to realize, is that she also mentioned that was for a solo GP fund. And the truth is, in the market, solo GP funds are not particularly attractive to folks. You usually need to have at least 2 GPs for a fund to really get to where it needs to go. Not saying that solo GP funds don't happen, but it's not preferred in the market, So I would consider that we would need to think about a limit that is at least going to provide, the minimum sustainable capital amount for a 2 GP fund, which would probably be 50 versus that 25 million. So, it seems to me that one area in which we could go is sort of looking at an increase to 1,000, which is increasing by 4 the number of beneficial owners, and also a commensurate increase in the aggregated capital cap by approximately 4 to about 50 million would also kind of make sense. So that's kind of where my thinking is on this, and would love to get other folks' perspectives on the numbers.
I agree wholeheartedly, with everything you said. I mean, from what I've seen, we're talking about the 25, but that really is the minimum. Just because of the costs associated with it. I think it is important to draw a little bit of distinction between what Ashok was taking about, how he's only raising 7 to 8 million, and they're not constrained there. That is also piggybacking on a whole lot of existing infrastructure that they get through Tech Coast Angels, so it's very different for a solo GP.
I also think the important thing to notice there is that his firm is structured with annual funds, and most venture funds have a 4-year investment period, so they would actually be deploying, 4 times 8 over that to sort of reflect a similar entity to what he has, would be like 4 times as large.
Yeah, so just to try to reconcile those two data points that we got. The other thing that if we're talking about the qualifying venture capital fund, I believe that's where the fund of funds limitation is right now, that you can't have more than 20% of your assets allocated. So if we're making recommendations, we may want to reiterate our previous recommendation about liberalizing that and allowing for more than 20% of your funds, perhaps, up to X amount in other qualifying venture funds.
Oh, okay. I'm sorry. Can you be clearer there?
Oh, sorry. Did I skip if I went beyond scope? In the definition of qualifying venture funds, one of the limitations within that is that you can't have more than 20% of your assets invested in other funds. And so that is what Sarah was talking about, the limitation on you can't have fund of funds, or you're limited in the amount of funds that you can have. In the past, we have made a recommendation to take a look at that to see whether or not you should be allowed to give more than 20%, invest more than 20% of your assets into other funds that would then open up a bigger window for fund of funds investing.
What's the rationale for limiting that?
I think it's risk, right? So it's adding another layer of you're now no longer in direct relationship with the portfolio company, with the operators. I was going to say the same thing. I think there is a bias, if you will, to touch the qualifying venture fund versus touching the actual original 40 Act 3C1, but it does have some of these knock-on limitations. And so I think by increasing the number of beneficial owners and assets under management for a qualifying venture fund, that is in fact driving that to direct portfolio company operating investment. And I think that's giving access to capital that way. But it's not solving another issue which we've heard, which is how do you encourage the pool of capital that exists today, which is our very large institutional LPs, the pensions funds. I don't think this is going to encourage them to
No.
play. So that
Yeah,
making
so,
sure
so
we
that's,
understand
that's
those two
not what
things.
we're making a recommendation on today. So, you know, we do have a lot of problems to solve, but I don't think that's actually affected by this particular category. And today, this is the area we'd like to make a recommendation. But absolutely, Rose, we are keeping in mind that a bigger picture area of concern and where we're all working on how can we make recommendations that can increase the interest of larger asset allocators to invest in fund of funds. Supporting emerging managers is probably a separate topic that wouldn't be accomplished with this recommendation. Yes, Vincent?
So given that you said that, could we, not on the question you asked, but on what you just said, could we maybe decide at some point to make that a topic of recommendation, like for a real discussion around that? Because we're going around the issue, and I know it's a harder one to tackle and engage with, but at some point I'm just saying if that could be something that we could look at.
So yes, absolutely. And, you know, I think that's our work here. So, you know, it's our responsibility as the committee members to figure out, is there a specific regulatory issue on which we could recommend a change that might have that intended effect? I don't believe anyone in this group has come up with one yet, but if you do, let's work on that. So we will all put our thinking caps on and this is why we bring in these speakers, because, you know, if Sarah were to say, I am impeded by, you know, regulation F-123, you know, we could then work on it. So I think that's the work that we have to do to get to that, but is very important to us as a goal of the committee.
So on the specific, you know, recommendation, I would suggest assets under management of at least $1 million because it allows that scalability of the venture funds. I would still consider 50 as
You meant 100 million.
What did
right?
I say?
You said $1 million.
I said, I meant 100 million. You're absolutely right. Because I think 50 is still, it's really going to skate some of the economics, especially when I was asking about adding in additional, you know, LPs and operational impacts. And then with this, if you're still investing, you know, local and staying in the community, the deployment of capital, your checks are not necessarily going to get bigger. Some will, but not all. And so that's going to increase sort of the back office. So I would actually encourage us to think something higher than 50. And, you know, just to go back on to the last point, I want to make sure that we are thinking, you know, as an emerging fund, a lot of emphasis on anchor LPs and who you're bringing in. And that is ideally a larger check size. And so when we have these limitations around funds of funds, there is still an impact. Those issues aren't completely separate from each other.
Jasmine?
Yeah, I was just going to say, as a procedural matter, we could, as a committee, recommend a range. I think, you know, ultimately the commission would make a rule proposal. There would be notice and comment for industry. There would be a lot of arguments about what's the right number. I'm sure the commission would be asking of the industry to comment at that time and provide data. And we can, you know, look at that when the time comes. So if we wanted to, right now, we could say, you know, the commission should look at increasing the AUM size to at least, you know, for instance, at least 25 million, consider a range from 25 to 100, something like that. We don't necessarily have to come up with a definitive number today.
That's very true. Thank you, Jasmine. Okay, great. Well, I know everyone's feeling a little bit hungry, and with the options that we have on the table, let's maybe just get started on where we can go with the recommendation. So, and perhaps we maybe go around the room a little bit so that we can get to an idea of where folks feel comfortable. So does the committee recommend increasing the maximum number of beneficial owners permitted for traditional 3C1 funds, currently limited to 100 or fewer beneficial owners? And that's not the venture capital funds, that's traditional 3C1 funds. Are we interested in making a recommendation to increase the number of beneficial owners there? If you say yes, raise hand. Okay, great. So we haven't really talked about that. Maybe, Davion, you raised your hand? Or who raised their hand over there? Okay. Do you want to maybe talk a little bit about your thoughts there and why you would recommend increasing the number of beneficial owners for traditional 3C1 funds?
Yeah, I mean, from my perspective, I know that it's a little bit different from the qualifying venture capital funds, but I think there were several discussions around, democratizing access and being able to, have individuals participate. Granted, in the traditional funds, they're getting capital from, different places, excuse me, as the qualifying venture fund. But I think that there's a huge opportunity to, as I said, democratize access, and if there's a situation where we can get additional folks in at lower minimums, then I think that something that we should explore.
Okay. Just would love to get a sense of specifically what you're talking about. So getting folks into like what type of fund or asset class that, like, can we have a picture of who might be affected that you're talking
So
about?
I may be talking about the qualifying venture
Okay,
fund.
yeah,
Sorry.
okay.
Yeah.
All right.
Yeah.
Okay. Anybody else? No? Okay. Okay, great. Number 2, with respect to the qualifying venture capital fund exemption in Section 3C1 of the Investment Company Act of 1940, does the committee recommend increasing the maximum $12 million limit on the aggregate amount of capital contributions and uncalled capital? If you're in favor, raise hand. Okay, looks pretty unanimous. So I think where we can probably get to a recommendation is, if so, why and by what amount? It sounds like for a recommendation, we're maybe falling somewhere between the $25 to $100 million recommendation range. So we should probably discuss this. I mentioned I thought 50 was kind of a reasonable number. Rose also threw out 100. 25 does maybe seem a little low. I know that Jasmine had mentioned that as sort of the possible bottom of a range. One thing I'll mention is that right now the legislation includes two numbers, 50 or 150. So I think we're definitely in the ballpark. Does anyone have thoughts on whether we should choose 50, we should choose 100, or we should maybe give a range of 50 to 100? Would love to see where people's heads are. Because, 100 would be kind of like 8 times above where we are now. 50 would be 4 times. Does anyone really care? I don't know. Like, let's talk a little bit. Heath?
I just have one question. I think a range makes sense.
Yeah.
But when I go back to the beginning of the language on the description, it's no more than.
Yeah.
Right? And so I think at the end of the day, whatever that cap is, you're going to eventually have to have a top line mark, just purely based on the language.
Yeah,
right?
yeah.
So, I mean, we can talk through.
We're just figuring out, is our recommendation that they set a cap in a range? I mean, I personally would prefer to just pick a number, because I don't think it's that difficult for us to do. So I think you're right. But yes, point taken.
Is there something that is would be so detrimental to investor protection, or that would, if it was 100, oh my gosh, that'd be awful, versus 50. I'm trying to figure out like where, what is, just thinking of.
Let's do that scenario, right? So let's say we increase the number of beneficial owners to 1,000, right? And now people that raise, let's say somewhere between the 75 to 100, right? Raise, I don't know, $99 million. Now have potentially 1,000 beneficial owners, and they've got almost $100 million under management. So they're generating, $2 million a year in fees. Are we saying that it is too financially burdensome on them to be registered and sort of, perform on the required regulatory requirements? Do we think that's too much versus, a $50 million fund is only generating $1 million in fees? They actually, may not have the extra money to pay for it. So it's really just, do we feel that, at which point is it creating an unnecessary financial burden on the institution? Rose?
I don't think it is, and I think it's leveling the playing field with mega funds that often do operate as exempt funds with the look-through on C31 or C7 with QIBs. And so I think going above that, perhaps, but I don't think at that level we've hit that. They're now able to compete in the allocations with the mega funds and have wider access of who their LP base is.
Okay, all right. Okay, great. All right, so all in favor of using 1,000 as the beneficial owner cap for the recommendation? Okay, all in favor of using 100 million as the AUM cap? Yeah, as the cap. 100 million is the cap. Okay. All in favor of something less than 100 million as the cap? No? Okay, great. I think we have our oh, sorry. I thought it was. Okay. Is anyone opposed to 1,000 beneficial owners as the maximum number of beneficial owners?
I'm not opposed to it. I think this may be one where we want to give a range and sort of kick it back to the SEC to sort of make a determination, only because once you get to 1,000, then you're running up against general solicitation issues. Are these retail investors? 1,000 is a lot. And so I worry that at that level, you're kind of butting up against other regulatory priorities. Again, I'm all 4,000, but that may be a good one to sort of put a range in there and sort of defer to the SEC to say, use your judgment as to what you think the right is. But that may be more of a nuanced aspect than is necessary for sort of a recommendation here.
Okay, all right. Okay, I think that that's interesting. I would love for you to sort of explain further what you mean. I mean, I personally think if we're going to make a recommendation, like we need to actually make a recommendation instead of just being like, hey, why don't you pick between, that's my own personal opinion, is that, we should be able to agree on a number. Tell me, you think there's a problem with 1,000, that it's butting up against something. Can you please be a little bit more specific on what you're referring to, and then which number you might suggest that would not butt up against some these other regulatory concerns?
So I'll say I'm fine with 1,000. This is more me sort of thinking out loud as I think through sort of like secondary and tertiary issues. My only point on that is when you start talking about having 1,000 LPs, it's sort of hard to envision a scenario where you're going out to get 1,000 LPs and not somehow doing a general solicitation.
Okay. Well, I mean, I think Ashok just gave us a great example, right? That he has 350 members in the group, and only 249 are allowed to be in the fund, and they actually have more demand than that. And that is, sort of just a local angel group, right? Not somebody sort of going online and, mass marketing, but would love your deeper thoughts on that.
Like I said, it's more me just sort of real-time sort of thinking about it. So I'll defer to the commission on what they think is right. I'm happy to recommend 1,000. Like I said, it was just more sort of as I was real-time thinking about it that starts sort of raising other sort of regulatory issues. But I'm happy to make the recommendation and let the SEC determine what's appropriate.
And can you just let us, which other regulatory issues do you think it would raise?
There are prohibitions on doing general solicitations for fund formation, so that would opt you out of like the 506, for example, unless you're doing 506C.
Right, so the intention here is that this would be a cap for people not doing general solicitation. So, I mean, it can be less, but that it's sort of just like the maximum.
Yeah, they're independent requirements. So even if we say you can have up to 1,000, then you still can't do a general solicitation unless you are otherwise qualified, like a 506C. So again, that's what I'm saying, it just starts to butt up against other regulatory priorities that would need to be sort of thought of holistically and then made consistent. So again, if we're going to say 1,000 is an exemption from the general solicitation one, again, I'm getting too far into the details for purposes of this discussion.
You cannot get too far into the details here. This is what we're here for.
Yeah.
So dig in.
Yeah.
No, I just have a
Jennifer?
quick question on that note too, because I'm learning more about these funds. So are you saying that typically with these qualifying venture capital funds, they would be more inclined to use 506C?
If you're going to do a general solicitation,
Okay.
you would need to go through 506C as opposed to 506B or I guess it'd be above crowdfunding requirements. But
And we can see from the data, most of them are not using 506C. 506C is used for a very small portion, so no.
But this, I mean, the inverse of that, given the conversation we had at the last meeting, the lack of uptake in 506C, and yet 506C, if you use it, it is providing an avenue of capital access that 506B does not. And so in the pooled fund context, if it's 1,000, or I do think, maybe we need to talk about that more. Are we actually,
Jennifer, could you just turn off the things because it's feedback?
are we actually, there is a consequence, but is it a consequence we want, which now pooled access funds have more incentive to use 506C because they can get up to 1,000. And so now are we not only sort of increasing sort of the access to pooled funds, but we're increasing how the pooled funds can access the capital, both of which feel like they expand access to capital for small business, which is in our remit. But 1,000 is a significant, jump. I mean, even if you went sort of the 2X, which was, the 600, which is already one of the previously proposed legislation, that would still allow more than enough cushion for the various scenarios that we had. So do we need to go, I mean, I think it's the same.
Just thinking back though to like our predecessors who sat in these seats before us and went from the 99 to the 249. Like, I don't want to sit here again 2 years from now and be like, hey, we were into 500, now let's go to 1,000. Like let's just make a recommendation that we can live with for a long time and call it a day.
And that was my rationale on the 100, right? I thought that 50 would, in 5 years, might be stale.
Yeah, that's a very good point. Okay, wonderful. So all in favor in recommending an increase to the maximum number of beneficial owners for qualifying 3C1 venture capital funds to 1,000, please raise your hand. Okay, thank you. All in favor of making a recommendation to increase the maximum number of capital commitments to a qualifying venture capital fund under 3C1 to $100 million, please raise your hand. Okay, wonderful. Thank you so much. Jasmine, we'll put you in charge of putting together a fabulous recommendation for us. I want to thank the committee for all of your very thoughtful consideration of this issue, as well as coming up with what I hope will be a very helpful recommendation for the commission. Marcia, any closing thoughts before we go to lunch? Okay, wonderful. We will break for lunch and see everybody back here in 1 hour.